I want to set everything I need to set so that we start the class. People that read for me in the last class are here. Miss Mary, okay, she's not here. Miss Chika, she's not here. Ah,
Miss Chika is here. Good evening, sir.
okay, Miss Chika, good evening. So I'll make you a co-host so you can read for me and call figures for me too. Judge Victoria, are you there? Okay, trying to look for people. Why are the men in the houses not behind? Men arrest, I beg. Miss Fetia. Yes, you can help me. Are you a calculator?
Yes, I am.
Okay, so you call figure for me. Olayinka David. Yes, Kaza. Olayinka David.
Yes, sir.
Asao now.
Sir, you called me now, I make an answer.
You that said you want to be a I thought you rest. Avoid me. Oh. So I've made Miss Tika a co-host, Miss Fetia a co-host, Fetia Adioti a co-host. Umi Akintoye with calculator. I just need 3 people, please.
Yes, I'll probably will have a call figure for you the last time.
Oh, okay. So I think I'm okay with just. I think I'm okay with those 3. So I'll make Umi Akintoye also a co-host. Anyways, so I already have 3 beautiful ladies as a co-host. Pick Mr. David to go and rest. So those 3 will call figures for me and also read questions for me. Like I always say, I'm going to mute everybody's mic. So anything you want to say, please, you can use the chat box so that we can have an effective class. So like I always say, or like I said, because you are not calling figures for me, does not mean you should not confirm. It does not mean you should not confirm the figures. Please confirm the figures and be sure. And if anything you don't understand, you can always raise up your hand. You can always send your reaction, and I will take my questions, and I would also unmute you. Please, my co-host, I need you guys to do me a favor. Whenever I say, okay, let me take questions, or whenever I say I'm asking the class, please always remind me to turn off their microphone, because like this, nobody can on their mic now. So please always remind me so that I can always keep that in check also. This has an advantage and it has a disadvantage. Advantage because at least everybody now, nobody can come and disturb our class. But disadvantage is me, I like to talk to my class. I like to hear a general reply. So for me to always be coming here and be turning on your mic, you'll be stressing me. But let's try it. Let's see how it goes. Then we can always move forward from it. Anyways, good evening, everyone. It's nice to see you guys' beautiful faces again. You're welcome to today's class. So we had our first class on Saturday, and believe me, it was productive. For me, I think it was productive. I actually think it was. Although there are still little here and there that will touch concerning the last class, like I promised. And there also another method I want to be trying now, which is that what I noticed in that last class was some people have generally forgotten some of the topics we've taught. Some people don't even remember the topics that were spoken about again. So what I've decided to do is maybe over the time, but today I have a bulky question to solve. The 2-3 questions I want to solve today are really bulky, so I might not have time to do that. What I wanted to do was maybe pick a topic, just brush through it. Maybe portfolio, brush through it, bond valuation, brush through it, so that it's comfortable for us. I think I will still do. There's still time. So I'll just take a topic, brush through it, so that at least it freshens your memory. Then I can continue my solving from there. I think that's better. So I think I will just do that. So maybe at the beginning and at the end, if time permits us, just to freshen our memory. So let's start, please. Let's start. You must pass by force by fire, whether you like it or not. You must pass, and I'll be here to see that. So, anyways, so let me just brush through your memories on 2 topics real quick. This is 8:10 for the next 30 minutes. Let me just brush through your memory with 2 topics. So I will do normal investment appraisal. I know you guys know it. I will do investment appraisal, and I will do what's the other topic? And I will do portfolio theory. Why am I doing those two? I'm doing those two because it involves the question I want to solve today. Yes, one of the questions is about investment appraisal, the other is about portfolio theory. So let me just use the opportunity to brush you guys' memory. Next class too, maybe I'll pick those two topics. Anyone that involves, I'll brush through it again for you people to pass. Anyways, let's start. Now, let me start with investment appraisal. I'm sure most of you, so I will not go deep because I'm sure you guys know it. It's just a summary. So what is investment appraisal? Why do we even do investment appraisal? My co-host, let's keep to time. This is 20, it's 8:20. Olami when is 8:40, please. 20 minutes. Olami when is 8:40. Because when I get in the mood like this, I go just display they go. So when it's 8:40, so I'll use 10 minutes for each of them. Anyways, what is investment appraisal? Let me start with investment appraisal. Most of us, we've been seeing investment appraisal, we see this, we see that, say, okay, what, like most people don't even understand the basics behind it. Most people don't even know why we do investment appraisal. Now, first of all, with investment appraisal, it does not just come with NPV. Let me start from the very, very basics. Like I told you that day, we have different types of, okay, let me say capital investment decisions, or let me say capital budgeting decisions. So we have different types. We have different methods that can be used for a capital budgeting decision. Now, we have the ones that are for the discounted capital budgeting. We have the ones that are for non-discounted capital budgeting. The ones that are for discounted are the ones that involves the discount factor. The one that involves you discounting. The ones that are the non-discount factors are the ones that does not involve you discounting. So the discounted capital budgeting methods are your normal net present value, your modified internal rate of return, your internal rate of return. Okay, that's for that. Then for the non-discounted cash flow, that's where you have your payback period, your accounting rate of return, and all those things. Now, in all of those things, it's easier for them to say, or for ICANN purpose, I don't think at this level or at this rate, there's nothing on my screen. I'm just doing a general review. So there's nothing on my screen. So like at this rate, I'm just saying for my own part, it's in your syllabus here, but I don't think ICANN will ask you to do accounting, payback period, and all those things at final stage. I don't think so. That's why we always stick to modified internal rate of return, and net present value. I don't think anybody will ask you to do payback period and all. You can lend them at your own. That's the non-discounted cash flows. You can lend them by yourself. And please, I'm saying the things you should learn on those things, the one I will not talk about. Learn all those non-discounted cash flow, the payback period, the accounting rate of return, learn the advantages and the disadvantages of them also. I think those are where it can come out from. Learn how to use them, and also learn the also learn the advantages and disadvantages, both the net present value, both the internal rate of return, modified internal rate of return, accounting rate of return, payback period, duration. Learn the advantages and the disadvantages. So I will not speak about the non-discounted cash flow. I'll speak about the discounted cash flow now. Now let me start with internal rate of return. Internal rate of return is just your IRR. IRR is so easy, so don't get it confused. There's a formula for it. But before you get to that formula, you have to use what? Two opposing discount factors. You know these things. You need to get a negative present value and a positive net present value. Some people or some books will say the higher use a higher rate and a lower rate. It's fine, it works. For me, I always say use a positive discount factor or a positive net present value and a negative net present value. So what it means is you pick one discount factor to give you a positive, you discount it now, normal, the way you do your normal NPV now. So you pick a discount factor that gives you a positive NPV, then you pick another discount factor that gives you what? A negative NPV. Now, what I always tell my students is the higher the net present value, the lower the discount factor. Yes, so you can always use that to do a cross check. So if your net present value is increasing, if you want to increase your net present value, what I'm saying is get that terminology, that sheet. I said the higher your net present value, the lower your discount factor. What I'm saying is, imagine you have a net present value. Imagine you use a discount factor of 15 and you have a net present value of, say, 10. Listen, use a discount factor of 15, then you have a net present value of maybe 10. So you need to reduce that discount. You need to reduce that NPV now. It's 10. You are going to negative. Net 10 is positive now, and you are going to a negative. Since you have gotten a positive net present value, you want to get a negative net present value. Instead of you doing a trial and error method, just trying discount factor. What I'm telling you is, for you to reduce that net present value to a negative, you need to increase your discount factor. So the higher your net present value, so if you want to reduce that, so it's still the other way around. So if you want to increase it, you reduce it. It's just basically like that. The higher your net present value, the lower your discount factor. Basically like that. So you pick a discount factor that gives you a positive NPV, another discount factor that gives you a negative NPV. You put it in the IRR formula, which is A plus, open bracket, NPV A over NPV A plus NPV B, close the bracket, open another bracket, B minus A. A is the discount factor that gives you a positive NPV. NPV is your positive NPV. NPV is your negative NPV. B in that formula is your discount factor that gives you a negative NPV. At this particular juncture or at this particular level, ICANN will not still ask you as a standalone question to calculate internal rate of return. They will not ask you now. They will not just put question C. No, it will not happen. I'm telling you. Where they will choose IRR is either they tell you either why you are trying to calculate your weighted average cost of capital, where you are not trying to calculate your cost of debt. Yes, now, because use IRR to calculate cost of debt. And while I was there, somebody asked the question that when do you use IRR? You use IRR to calculate cost of debt when the bond is a redeemable bond. We have two types of bond now. We have two types of debt, basically, the redeemable and the irredeemable. Redeemable is the ones that at the end of the year you are redeeming at the particular amount. You are redeeming both the principal and the interest. That's a redeemable bond. But irredeemable bond means that you are not redeeming it. You just be collecting interest. You are not collecting principal. There is no date. So how do you know when the bond is redeemable or when the bond is irredeemable? If you check the question, all the information is relating to the bond. If it's a redeemable bond, you will see number of years there. Shemba. But if it is an irredeemable bond, there will not be information relating to the redemption. There will not be information related to the years of the redemption of that bond. No years. Because it is not redeemable now. There is no number of years attached to it. So that is when you know an irredeemable bond. And it's still the same formula with how you do your cost of equity. But for this one now, market value of a bond is equals to interest, 1 minus T or 1 plus T, over what? Over your cost of debt, normally. So if you're trying to get cost of debt, it's just the other way, cross your multiply. Then you have your interest over what? Over your market value, according to what the lady that answered, according to what she answered. That's correct formula. Interest over what? The market value. I've diverted a little, but that is just where IRR comes in for you. Calculation of your cost of debt in your bond valuation. That is where you use IRR. Modified internal rate of return is just like an advanced internal rate of return. Imagine just you saying, we don't trust this modified internal rate of return thing. Let's do something else. That is where modified internal rate of return comes in. And for modified internal rate of return, there's a particular formula. There's a formula to it, which I'm going to give you today, that makes your job very, very very easy. It's the PV of cash inflow over PV of cash outflow, open bracket 1 minus n, R raised power 1 minus n minus 1 is a big bracket. I'm sure I've given that formula before. I'll still give you that formula again today. Anyways, that is for modified internal rate of return. Nothing really special there. And modified internal rate of return rarely comes alone also. Usually, either they've told you to calculate your net present value, then they not tell you to use those information for net present value to calculate your modified internal rate of return, which is what our question today practically looks like. Now let's go to the big boy, which is the net present value. Why do we do net present value? Net present value is just simply the problem with net present value is, imagine now, as at today now, I want to go into real estate. Listen, I want to go into real estate business. Maybe I want to invest in a real estate business. Then somebody is trying to pitch the idea to me, and he's telling me that, okay, if you put 1 billion, it's not CBEX, so real estate. Say if you put 1 billion, in the next 5 years, say you would have gotten your 1 billion back with profit. Okay, as an accountant, you will be you will be curious. How do I make? Then person comes here and say, okay, imagine that your cash flow for a year, like total cash flow for a year, is maybe you're making maybe 100,000 every year. That's the cash flow that comes in. The person just dropped all those things. The problem is what you have in your front is figures. Yes, now the only thing that's in your front is figures for those years. How are you sure that you are not in that year now? You are not in year 5. You are not in year 4. How are you now still sure that the time value of money would have not affected those cash flows? You know what time value of money means now? This is an example of what time value of money means. A perfect example, like I always tell my students. One day I went to buy what's the name? A team container. People say I like this story too much, but they pay me. They pay me where now. So I went to buy this Pepsi, this team after a physical class, this team Pepsi. Then I got there, I gave the lady 500 naira. I did it, I was sipping the Pepsi, this team. I don't drink them. I was still standing in the front. I don't drink them, which half. Okay, where my change now? The lady was like, the team is 500 naira. In my head, I'm like, what? How is a plastic team now 500 naira? My plan or my point now is, as at beginning of the year or as at last year, that same 500 naira could have bought you at least 2 teams. Yes, now maybe 200. So what it means is the value of 500 naira now as now what? What he could buy before is not now buying it again. So the value of 500 naira has now dropped. What you could buy with 500, what 500 naira could buy before is not now buying it again. So time value of money has affected it. I have 10 minutes left. Thank you. Time value of money has not affected it. So that's the basic point of doing the net present value. You are trying to affect, or you're trying to, okay, now somebody said you make 1 billion naira in the next 5 years, but I'm not in that 5 years now. So what you are trying to do, you're trying to bring that 5 billion naira to today, so that you will know the value of that 5 billion naira as at now. So there will always be informations in your there will always be a lot of grammatical informations in your questions. But where the problem used to come from is students used to misquote the growth rate. They tell you that it's going to start growing from. They tell you that okay, their sales will increase. We know how to go now. Their sales will increase by 5%, will increase by 10%. But the problem, some questions can say it increases by 5% as at I don't know, maybe as at year 1, or they tell you that it increases 5% for as at now onward. Listen, it's English. Whenever you hear words like currently, now, immediately, which one do they used to use again? I don't know. Anything that involves current, that involves as at today, or if you hear as at today, you hear it means year 0. Anywhere you hear as at now, currently, presently, immediately, that's all those grammars that involves them saying that is happening now. Please, year 0 is what we don't have year 0 yet. There's nothing like year 0, but like it's just the terminology that we use, or the number that we use to qualify as at now. That's what year 0 basically means. So any information that you see that is as at now, that you see as at year 0, take it as at what? Take it as at now, please. And always take all your cash flows to always happen at the end of the year. I'm telling you the basic tips now. Always take your cash flows to always happen at the end of the what? At the end of the year. Always take your cash flows to always happen what? At the end of the year. Very, very important information. Always take all the information to always happen at the end of the year. Another thing with net present value generally that causes problem with students is working capital. If I explain working capital with my mouth now, most of you will get confused. So what I will say is there's a question 2 that will practicalize working capital. So because why I said that you will get confused is I've seen 4, 5, 6 lecturers explain working capital to students, and all of them explained it in different methods, different ways, and it simply meant the same thing. It simply meant the same thing, like calculation. So now, I have a method that I used to use, and that's what me and my students have been using, and it has been helping us. I'm saying for people that have never been in my class, anyways, it has always been what helping us. So I'll bring that method and we'll use it also. But let me just tell you the general assumption with working capital. General assumption with working capital believes that working capital should be introduced at the beginning of the business. What working capital simply means is I want to sell a real estate business. The money I'm going to be using to do operations, that's what working capital means. So it means that the assumption is introduced at the beginning and it is recouped at the end. at the end of the business. It's introduced at the beginning and recouped at the end of the business. But for the purpose of calculating net present value, you don't use the exact figure of the working capital. It's just the difference. What it means is, imagine your year one. Okay, when we say it's introduced at the beginning, it means at year zero. So your working capital majorly is always introduced at year zero. Fine. But when we now see the difference, so imagine you introduce 150 year zero. Then year two, the working capital you spent is now 75. What it means is, for the purpose of net present value, don't use 75 for that year two. Take the difference between 150 and 75. That is what is in year two. Are you listening to me? Oh? Take the difference. Then year three, now you know year two, you spend 75. Year three, now you now spend 60. Don't put 60 in year three. Take the difference between 75 and 60 and put in year three. So for working capital, it's always a difference. I'm not showing anything on my screen. Oh, I'm just explaining to you. So that is just and at the end of the year, add everything together and recoup everything at the end of the year. Or recoup everything at the end of the year. So that is just a problem with working capital. Another problem is taxation. Taxation can be charged two ways, either immediately or in arrears. So there's one that you charge. So profit of this year will be profit of this year. If you make profit this year, you charge the tax next year. That one is not charged immediately. That one is charged in arrears. So profit of this year, you take the tax next year. The one for year two, you take the tax next year three. So anytime, I always tell my students, anytime you see, so once you read your information, just know what the things to do. So anytime you see, madam, so anytime you see in arrears, something should come to your head that you have an extra year. I don't know if all these things make sense. If you have been in my class before, I don't think you have a problem with anything I'm saying. Anytime you see in arrears, there's something that should come to your head that you have an extra year. Like if the old stuff was 4 years, it means you have an extra year and it's 5 years. But if it's advanced, there's a probability that you will not have an extra year. So that is just basically that you're having an extra year for that previous one because profit of year one, you are taking the tax in year two now. Profit of year two, year three, profit of year three, year four. So there will always be an extra year where you charge the tax in the next year. So please solve questions on that. Another problem is, what other problem do we have? Capital allowance majorly. There are two ways to charge capital allowance, either a reducing balance or what? Or what's the name now? Or straight line, either reducing balance or straight line. If it is a straight line, you have a figure, you have the same figure over the years. Just divide your initial outlay. Maybe it's 2 billion, it's 1 billion. Divide your initial outlay by the number of years. Sometimes some questions will not give you the number of they will not give you the number of years particularly. Say some of them will give you the number of years. But what I'm simply saying is, okay, some people might not give you, some might not give you the reducing balance rate. Hey, God of mercy, I don't blow too much grammar. What I'm simply saying is sometimes the rate might not be so. Let me use reducing balance. Straight line, they will give you the number of years. Fine. But for reducing balance, in some situations, they might, or in most situations, if I can't want to be wicked, they will not give you the rate. Yes, now they will not give you the rate. Say they will just tell you charge this thing using reducing balance, or capital allowance can be charged using no rate. What they are trying to let you know is that they've given you the number of years to be 4 years. And divide 100 by 4 now, you get the rate. If number of years is 5, divide 100 by 5, you get the rate. So for that reducing balance, be very careful. Sometimes they might not give you that rate. But for straight line, they always give you the number of years in the question. So just divide that one. But for reducing balance, we don't give you the percentage. Divide 100 by the number of years, you get the rate. So that rate is what you now charge on the initial outlay that you'll be reducing. The reducing is so after you've gotten your capital allowance, you will now charge tax. Don't forget that what is coming to your MP. Listen to me here, students. People are not students, sorry, professionals. Listen to me here. What is coming to your NPV? It is not capital allowance. So what is coming here is not capital allowance. If you are charged 25% on your capital allowance, that is not the figure that is coming there. Because what is in the NPV format is tax saved on capital allowance. So after you've gotten those capital allowance, you will now go and charge your tax rates. Or they will tell you, if it's reducing balance, they will tell you they want to use. You will now go and charge your tax, either tax is 20% or 25%. You will now go and charge tax, bam, 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 on that reducing balance, on that figure that you've gotten. On that reducing balance, you just go and charge tax. Or that's the exact figure that is going to go to your NPV. So after that, you are done. Just discount. Use your CAPM, get your cost of equity. If it's work, go and get your work. Use your work to discount. Go and use your work to discount. After discounting, you move on, and that is the end of NPV. I don't tire. Anyways, let me see the questions that you guys have dropped. Let me see if I could answer each of them real quick. How do we know it's a disimbalance? They will tell you in the question. Anyone you can use. I should drop the recording. Okay, no problem. Okay, so that's just basically that for that. I'll still take questions, don't worry. But like that's basically that for that. Anyways, I still have my timekeepers. Give me 5 minutes. Let me run to portfolio theory. Let me run through the no. Let me run to portfolio theory together. Fast, please. Are we taking tax before working capital? It depends on you can do anyone first. You can do anyone that's comfortable for you first. But there's a format for MPV. There's a format for it. Don't worry, there's a question we want to solve today that involves a proper structure of MPV. So you see the way the structure, although the question still, but like the question was not testing MPV particularly, it was testing combined company weighted average cost of capital. But like you will still see the structure of NPV there. So I think that's better. So let me go into portfolio. Ashot, I'll take your question, please. Hold on. Let me go into portfolio theory real quick. You told me I have a sweet voice. Is that why we are here? You should better listen to me and leave that your friend. She's distracting you. No one more. Oh yeah. Portfolio theory. Now, what do we mean by portfolio theory? Like I always explain, portfolio theory is just simply, your portfolio generally is just you having a basket of different investments. You know the way you go to market. Please, I've left capital investment decision. I'm in portfolio theory now. So portfolio theory, you know the way you go to the market now, that you have a basket. You put oranges, you put apples, you put pineapples. It's just the way portfolio. It's just the way a portfolio is. Portfolio theory is just you having just like a bag of you having different investments. A bag that you have real estate, you have bonds, you have preference shares, you have different types of investment in that portfolio. That's what a portfolio theory is. Now, why do we need to do this theory? Why do we need to do this topic in SFM generally? We need to do it generally because what we have two elements attached to every investment or every business in this life, even human beings, even our life. The elements are attached to, which is the risk and the return. Anytime you want to go out early morning from your house like this, those two elements are factors: risk and return. You are going because you want to go and make money, you want to go and make profit, but they are the risk. Can you come gunmen? This one gunmen, that one gunmen. Exactly. So that's where there's portfolio, because every investment has its return and has risk. So as financial managers as financial managers, you need to be able to account for the risk and return of every investment. Now let me come to the risk part. First of all, we have two types of risk. We have the systematic risk and we have the unsystematic risk. I'm not saying all these things for fun. I'm brushing your memory. Now you will know if you have read, or you have not read. Some of you, your conscience is already judging you. Say, so me won't go write this exam. You sure say me won't go write this exam. I'm sure some of you are already like that. But anyways, we are still here together. So as I was saying, we have two types of risk. We have the systematic risk and we have the unsystematic risk. For systematic risk is just like whenever you hear systematic risk, think of COVID-19. Whenever you hear systematic, just think of COVID-19, think of earthquake, think of think of war, think of political when there was that riot, that subsidy riot that they had to close down ahead. Because what systematic risk means? Systematic risk simply means Ebola, exactly. Systematic risk simply means that this is a risk that is affecting everybody in a particular, like in every industry. Is affecting every industry. That is what a systematic risk means. Either you are in a music industry, you are in agricultural industry, you are any industry, you are that particular risk is affecting everybody. When there was COVID-19, plus whiskey though, plus people that are doing farming, plus everybody sit down in their house. So that's a particular risk that affects everybody in the particular in the industry. And systematic risk can be measured with beta. Please, systematic risk can be measured with what? With beta. It is also called systematic risk. Sometimes it's also called unavoidable risk. It's called unavoidable risk, non-diversifiable risk also, because it cannot be diversified, although it can be hedged against anyways. but it cannot be diversified. It is unavoidable, and it is also called beta risk. Example is, I've told you, war, inflation, COVID-19, terrorist attack, all those things. Why unsystematic risk? Because systematic risk is a type of risk that affects a particular company or a particular industry. It's not affecting everybody. It's just affecting a particular industry. Example now, if dollar rate should go up, although in the part of the world that we are now, dollar rate affects everything, which is fine. Don't let me use dollar rate as an example. Let me use another thing. Let me say now a perfect example. When Tinubu administration came, they stopped all this bureau de change. I don't know if you heard the story. All these abokis, they stopped them. That's a regulatory change. They limited them. They collected some people's licenses. They reduced them. They are the only ones that are affected. Most of you don't even know the story. It did not stop you from not going to your work. It did not stop anything. So it's an example of a regulatory change that affected them, which is not affecting the whole. It's just a particular industry. And unsystematic risk is also called avoidable, diversifiable, and it's also called alpha risk. It's also called alpha risk. That other one is called beta risk. This is called alpha risk. Now, let me go to portfolio diversification. Let me go to portfolio diversification. When you hear portfolio diversification, what portfolio diversification means is, in short, don't put all your eggs in one basket. That is just simply what diversification means. Don't put all your eggs in one basket. Diversify. Put in your portfolio. Don't just have shares. If you have shares, if all the shares fall at the same time, so what portfolio diversification is? Okay, have shares, have bonds, have real estate, have agri, have gold. So diversify your portfolio. We have major three types of diversification. We have what we call horizontal diversification. We have what we call concentric diversification. And we have what we call conglomerate diversification. No, we mean they go write this exam for all these things to be in my head. I'm expecting to be in every one of you's head. But I know they go write the exam. But anyways, you have what we call horizontal. That some of you are already shaking your heads. God, nothing did there. No, Allah. Now your own you did. Anyways, we have horizontal diversification. We have what we call concentric diversification. We also have what we call conglomerate diversification. So whenever you hear horizontal diversification just simply means that I'll just give you the examples. Then you can always picture the meaning. What horizontal diversification simply means is you are just introducing a new product or a new service to whatever you are doing. So before we used to know what's his name? We used to know Biggie Cola, just Biggie Cola and Biggie Fanta. Then all of a sudden, Biggie everything just did. Nothing will no get Biggie again. Biggie Lime, Biggie Lemon, Biggie this, Biggie that. That's example of horizontal diversification. It's still the same. It's still the same technology. It's still the same. It's still the same bottle. It's still the same technology, but they just changed the content. That is what horizontal. I'm giving this example so that I can easily remember. That's what horizontal diversification means. They are just adding a new product just to satisfy their customers. Nothing is changing. Example, I've given you an example. When you hear concentric diversification, what is happening is that how would I explain this one now? For concentric diversification, they're adding new and related oh God of mercy. Okay, now let me start again. No, okay, not start again. Let me explain it again. Because horizontal and concentric can be mixed together. They can be mixed together. Now let me use this as an example. For horizontal diversification, you are introducing a new product, fine, just to satisfy your customer. But the product is not particularly is not related to the ones on ground. So I think that my Biggie Cola example might not fit for this horizontal. It will fit better for concentric. What I'm saying is you're adding a new product, but it's not related to the ones on ground. So let me use Coca-Cola. Before there was Coca, but it's still the same technology. So they were doing Coca-Cola and Fanta. All of a sudden they brought out Fafa Life. It's a new product and it's not particular. It's a soft drink, but it's not particularly related to the ones on ground. But concentric is the perfect example of that. What's the name of that Biggie? Because they are adding a new product. To the existing ones. maximizing the potential of all the existing technology and marketing they already had on ground. You know, when they were selling Biggie Cola and Biggie Fanta, they had all technology, they had marketing, so they just added new product to it. But for horizontal, is a new product, but it's unrelated to the one on ground before. But concentric, that one, new product, you are moving a new product that have no technological, no technological relation with the current product. Example now, as you were doing Biggie, you just go do Biggie Gala. That one, no, you know, gel. You don't do Biggie soft drink, Biggie Coke, Biggie this one. All of a sudden, they say you want to do Biggie Gala. Note, is it the same machine that is pouring liquid inside cup that will do put Gala inside nylon? That's example of what concentric diversification simply means. Now we have formulas to calculate calculate risk and return. Please check out those formulas. It's a long formula. There's one that we call one snake formula. It's a very long formula like this. We used to calculate our asset and we used to calculate our portfolio asset and our portfolio risk. Now, the major part of this portfolio where I can use to ask the question is we have what we call required return and what we call expected return. In most questions I've seen, they will give you what required return is. But normally, it's you that will go and calculate your expected return by yourself. It's you that will calculate expected return. So after you've calculated expected return, you would now, what's the name now? You would now, you will not compare. You compare your expected return to your required return. There's a terminology I call it. It's called NOPU. Let's call it NOPU. NOPU as an NOPU. Just make it easy for you. NOPU. NOPU. NOPU means that negative means that is overvalued, right? Positive means that what is undervalued. So, because you compare. Now, what we mean by comparing, it means that you subtract, and now you subtract your required return from your expected return. So once you subtract your required return from it, you get a figure. That figure that you get, if it's negative, it means it's overvalued. If it is positive, it means it's what? Undervalued. Whenever it is overvalued, it means what? You should sell more. People should give me thumbs up. Give me reaction if you can remember. React if you remember what I'm saying. Either raise up your hand or something. Good. People should remember. It's only 2 people I'm saying that are reasonable out of 200. Okay. So we shall call it no puru. I'll do my own. I'll say my own. Anyways, no puru. Negative means overvalued. Positive means undervalued. If it's overvalued, sell more. If it is undervalued, buy more. NOPU, NOPU. Negative, overvalued, positive, undervalued. If it is overvalued, you sell. If it is undervalued, you buy. And if it is zero, I don't know. You do it in your mind. Hey, like zero means it is perfectly, like it means it is perfectly valued. So you hold it, you hold the asset. You will not say and you will not buy. You hold. It means it is perfectly valued. So you will not be. It's not you will do it in your mind though. You will hold or you will keep. That is what zero means. Now I said that they will give you required return. Mostly they will give you required return in the question. It's expected return you are supposed to find. How do you find expected return? Usually in the recent questions I've been saying, you use CAPM. Usually that I've been saying, you use CAPM to calculate your required. But the problem is they will not give you beta. That is where the lock of the question is. They will not give you your beta in the question. They will not give you beta. So it's not left for you to now go and find beta. And for my students that have listened to my voice before, I gave you 4 ways to determine beta. One that has to do with excess returns, one that has to do with returns on security and returns on market. One has to do with covariance. One has to do with correlation coefficient. Then one has to do with all this plenty summation, rubbish. There's plenty like this. I said one has to do with excess return on security and on market. The other one has to do with correlation coefficient. The third one has to do with covariance and variance. Right? The last one is about summation. But the problem is, usually, is the one of correlation coefficient that is common. That's one that is very common that I can bring out most times. Correlation coefficient. That's your correlation coefficient multiplied by standard deviation of the security over standard deviation of the market. That's the hair. But if I can want to know, that's the one that they bring out most times. So you can check that and see it out. So that's the one you use to calculate your required return. Then you compare your required return to your expected return. Then you get it's called alpha value. So in some question, they can ask to calculate alpha value. No say that Mr. Shelley did not tell you, did not teach you. It's also called alpha value. Sometimes they tell you alpha value. That's why they say check the valuation of the Kinecon. It's just big grammar. But just know what you are saying. Just know what you are saying. No be me talk no poo. You people are very funny. God of mercy. No poo and rule. Rule as in RULE. No poo and rule. This is just no poo. Leave the rule. I don't die. Anyways, that is my brief introduction on that. So this is 4 minutes. For the next 6 minutes, please raise up your hand if you want to ask me any question, please. 6 minutes or 5, please. I have a lot to do today. Raise up your hand now. The only hand I see up is the only one I take question from. It's not after I've started that you now start asking your own question. So I'm taking only Joy Promise's question. So Joy Promise, you go calm down. I never sabi really control this thing well. So oh yeah, Miss Joy Promise, I can hear you now. Real quick, please.
Please, Mr.
Good evening, ma'am.
Please, I want you to throw more light on this concentric diversification and horizontal diversification. I think I didn't get it right. There was a mix-up.
You know that Mr. Adelabo has said they will increase tariff on light now. So they throw light anyhow now, go easier. But anyways, what I said with that one was that which I talk again. So let me just give you the example I said. I said that when it comes to horizontal diversification, you are making what's the name before? You are making Pepsi, Coca-Cola and Fanta. Then you just made Five Alive. So it's just like you adding an unrelated product. Just like you adding an unrelated product to it's a new product, but it's not particularly unrelated to the one on ground. Please, this thing I'm saying, if they ask in exam, don't be relating it to Coca-Cola and Fanta. Relate it to business, to portfolio. Please, thank God I even remembered. Don't go and be adding it. Don't go and be saying example, Chivita and Laila. I'm just saying the one that you remember. Related to portfolio. So okay, maybe somebody was investing in shares. Then all of a sudden it goes to maybe invest in bond or something. So just tweak it something like that. But what I'm trying to explain to you is English. What I'm trying to explain to you is you are producing Coca-Cola. Then all of a sudden you add a new and unrelated product to where you were. This one is horizontal. So you now add Five Alive to the list of Coca-Cola. When it comes to concentric is you adding a new product and a related product. You are still maintaining the marketing and the technology. Is the one that was pouring the Biggie Cola, Biggie Fanta. Is he the one that will pour Biggie Lime now? That will pour Biggie Strawberry. It's still the same technology that will pour. But for the last one, conglomerate, you're adding a new product, but it's not related to what is on ground. No technological reliability, no technological relationship safe. Example, I said you were making Biggie Cola, Biggie Fanta, Biggie everything. Then all of a sudden, you can't go do gala. This Mr. David, you see why I don't want to make this man a co-host? Because I know, say, man, now why people ask me when a man they do, man? Women, they always coordinate. And they give example now. This man say, imagine, say, Portable, leave music, go and be doing boxing. That is conclude. Ask how now? This man, you are not a serious person. So, Miss Joy, but his example still works anyways, but that's what conglomerate is. Is that fine?
Yes, thank you.
Yeah, very welcome. I said I wanted to take one question. Now, you people know, Mr. Ayuba, yeah, fast. Flash allow you. Talk to me. Fast.
Yes, thank you. Sorry, thank you very much. It's about what you just discussed now. Can we call that second one? I'm trying to remember now. Not a conglomerate, so the other one. Can we call it Vatica?
This one we will not even understand the name. I want to understand. But yes, you can call it
Me
vertical.
now. Don't you have me now?
But please leave it concentric. Leave it concentric.
Concentric.
Leave
Okay,
vertical.
concentric. Okay, all right. Thank you.
Yeah, Mr. Yuba, talk to me fast.
No. So I wanted to plead, maybe you will help us if you can retrieve your note for portfolio theory, so that we'll follow up with those method of
You people are not,
calculating.
all of you in this class are not serious people now. I told you people in that last class that somebody, we were about 200 in this class. Somebody should go to our group chat. I lost the chat on my phone. Somebody should help me send all the materials and all the working note I've sent to the platform. Over like 200, no one single human being sent to me. So there's no way. Only if somebody can do it. Somebody sent, even me, I need it so that I can have it in mind and I can share to you people. Please, somebody should try. I know people that have been in my class in the beginning. I know people that have been in my class from the beginning of this diet. So please now, just check the group chats. You'll see all the materials and all the working notes there. So please send it. Most of these things I'm saying, some people here never hear them before. So please help me so that I forward it to
Sir,
them.
but the group is locked. The
Yeah,
group is locked.
but you can take document out of it now. Just take it and forward it to my own DM. Forward it to my own DM. Forward it to my DM. So, anyways, please, that is forward it to my DM. I'll just forward it to the revision platform like that. I think that works. Please just try. The notes are much, but please just try. Thank you very much. So I'm going back to blocking everybody's microphone now so that we continue. Anyways, that's that for that. 9 o'clock. We can start. I hope I can solve all this. So now let me do so now I heard that there were, let me share my screen now. So let me so based on our last question, I think there were a lot of DB on our one. I think was it 1A? I think it was 1A now. Miss Chika, she been at 1A.
I think 1B.
1B.
1B, sir. 1B.
So there was a lot of DB on our 1B. So let me attack that fast in the next 10 minutes or 15 minutes. Although I think when I later finished and I checked the solution, we even made a mistake somewhere anyways, but let's still it's not a big mistake. Anyways, now let me first explain where is that material. Let me first explain what we are trying to do to you first. Maybe you guys will understand. So I never even come up with all these days. So see, this is the question. Okay, if you can see, I hope everyone can see my screen. If you can't see my screen, I think it's from your end. Please show a reaction if you can see my screen, please. Okay, or sorry, sorry, let's do like this. If you are putting your hand up, put your hand down. Joy, promise, please let me put your hand down, please. Joy, promise, please put your hand down. Now, raise up your hand if you are not seeing my screen. I think that's better. Please raise up your hand if you are not seeing my screen. This is about 3, 4, 5 people not seeing the screen. So let me do it again. Then if I do it again and you don't see, I think it's your network. So now, like this, nobody should be able to see my screen. Nobody should be able to see my screen now. So I'm going to now do this again. I hope everyone should be able to see now. If you are not seeing, try to log out and log in again. I think it will be your network. But I think everybody should be able to see now. If you are not seeing, I think it's from your network. Anyway, so let me continue. So we were able to solve this a part of this question comfortably. Won't kill me with messages like this. Okay. So we're able to finish this part comfortably, Abi. So it was this B part that says, show how the entire benefit from the takeover we accrue to the present shareholders of King PLC, assuming that the takeover prices are good at half of the figure you advise, and the purchase consideration will be settled by an exchange of ordinary shares in Queen PLC. Now, what I said is, first of all, you need to be very smart in exam conditions. Normally, you need to be very smart. If I were you, this A part was not that hard. This A part was very simple. 6 marks successfully collected. Factors that will affect that you must consider in accepting their takeover. This one, even if you don't know the exact words I give you, if you cook English very, very well, yeah. If you cook English very well, yeah. I thought you get 3 marks. Yes, now. It's just grammar. Factors that the directors and shareholders of both companies might consider in assessing the acceptability of proposed takeover. If I want to buy your company, what are the things that you will consider and me say I will consider if I want to collect the takeover? If you cook grammar, say how am I the sales revenue? How am I so sure your sales revenue will your cash flow? How am I so sure they would is what you are telling me that it is? How am I so sure that your debt to equity ratio is what it is? How am I so sure of the efficiency of your staffs? or of your management? How am I so sure that all the figures oh, no, these ones are different from the ones I gave you. I'm just saying that even if you cook basic grammar, basic English, you cannot lose all the marks. You can get 3 marks comfortably. 6 plus 3, 11. This one, 5 defense tactics. If you are the ones that have read, you can comfortably get 4, 5 marks here. If you've read, though, because I've given you all those defense tactics. Sandbag, poison pea. Somebody says Saturday special. And the they see now. All of them, I don't like. There are plenty, like about 6 or 7 that I gave you guys that day. Write them out, write explanations on them. Then if you get 4 plus 6 here, 10. 10 plus 3 here, that's 13 or 14 out of 20 marks. I don't think it's bad anyways. 14, 20, 37 to go. But I'll say explain this B part to you. Now, what this B is saying is, listen to me. What this B is practically saying is, you know, we got a prize here. We got an amount here, the maximum price. I've forgotten the amount, but no, we got a price here. What these people are now saying that, assuming that please, it's okay. Don't send the material to me again. I just they see 33 notifications now. It happened. It's okay. I think somebody has sent it to me. People want to blow my WhatsApp. Anyways, as I was saying, what these people is saying, what this question or what this is saying is, imagine that when this takeover wants to happen, they now said that. Imagine that instead of them paying, let me check that. What was that amount? What was that maximum price again? Somebody check it and tell me, please. What was the maximum price that we got? My co-host, you know that everybody are muted now, so people need to be very active. What was the maximum price we got? Where my co-host today? I didn't know more co-host. Michika, can you talk?
Sir, I'm looking for it, sir.
Oh, okay. Hey, I'm here. 75
million.
75 million. Good. So now, what this question is now saying is, imagine that they are planning to now, listen, you know it's king and queen. What this question is now saying, imagine that king is now saying that, okay, instead of just giving you 75 million, let's give you half of it, which is about 37.5. Let's give you half of it. But after that half, we will now dilute our own shares. We will now dilute our shares and give you part of our shares. That is just what this grammar is saying. Instead of you collecting 75 million, we'll give you 37.5. But we'll now give the shareholders of that coin. Instead of you know, when they give them 75 million, they are supposed to go now because they've bought the company. They're supposed to go and find something else to do, maybe do agriculture or do something and leave bank wala. But they are now saying, okay, we don't have 75. Let's give 37.5. But we'll now still give you shares. But the problem is that shares that they will give them, they don't know the exact number of that particular shares that they will give them. So that is where the problem now came from. So that is what we now did here. Listen, so that is what we now did here. By saying that this 37.5 is half of that 75 million, which is the market value of coin. It was supposed to be 75 before. But because they wanted to pay half, that's the value they wanted to pay now. Instead of 75, they wanted to pay half. That's 7.5. That's what this is. So it was supposed to be, wanted to get the value per share of coin. Normally it's supposed to be the total market value over the number of shares that is given to them. That's supposed to be their value per share after the merger. Yes, now that's supposed to be their value per share. You know when they say, is that thing you people used to do in CL? You remember when they say ordinary share 2 naira and they have 20 million of it? What is their value per share? Do you guys remember when they say ordinary share capital 2 naira? They now say they have 20 million naira worth of it. You want to get the value per share. So you do that 20 million divided by that 2 naira now. But yeah, now the problem is we don't even know the value of the share. We don't know the number of shares, and we don't even know the value of the shares. So that is why we have X here. That is 37.5. That is the value over the X, the number of shares. Fine, we don't know it. And this one must equal to this one. Value per share must equal to your post-merger value per share. Now, this is the formula. Just cram this formula. This is not the formula for post-merger value per share, which is your post-merger value. Which is that's this 250 million we calculated here. That's the value of the combined company. That's the total value, 250 million over the value of what is supposed to be under here is supposed to be the total number of shares that King PLC has presently, the one that is issued out, plus the one that is now going to give to Queen. That's one that is supposed to be under here. But we don't know the one that is going to give to Queen. That's why we represented with X. So we just did 250 over the one that he has presently plus the one that he wants to give to Queen. Equals to, according to what is here, they must equal to each other, equals to this. Then if you solve, you're supposed to get the two of them are supposed to be the same, which is what we had there. Now, the general question that day was, where is this my 1,000 coming from? That's the general question I was getting that day. Now, where this 1,000 was, this 1,000 is not in the question. I know some of them go down the check question. This 1,000 is not in the question. It's based on the figure. It's what people were giving me. Now, if you look at our question very well, most of our question was, if our question came in million, but when we were writing it here, we raised up to power of 1,000 now. See what we did. This thing here was supposed to be 75 million, but because we were raising up to the power of 1,000, we wrote 75,000. 175. This was supposed to be 175 million, but we wrote 175,000. This was supposed to be 37,500,000, but we wrote 37,000. So we're raising to the power of 1,000 from beginning. So what now happened where we got here? So this one we're supposed to use 250 million. So if you multiply this 37,500 by this 50,000, what you have here is not 1,875,000. It's 1 billion. What you have here is 1 billion, not 1 million. But because of the power of 1,000 that we've been raising up, so that 1,000 cannot allow us here to have the exact figure. Yes, now it cannot allow us to have the exact figure of the shares. So that's why we now multiply this by that 1,000 that we've been hiding since. Let me just call it hiding. That we've been hiding since. So it's just this 1,000 of but your calculator no go just agree. But if you use the exact amount from beginning, the million, your calculator no go agree. The figures are big. But if you use the exact amount from beginning, when you get here, you might not need to multiply by 1,000 again. It will give you the exact figure. But because we were raising up to power of 1,000, that is why. This one, 250 million multiplied by you, the calculator will be telling you times 10 raised power, all those things are the reason why we had to just do it like that. Then multiply by the 1,000. So it give us 8,820 to divide. Let me change this then. Change this to 8,820 so that you guys don't get confused from here. 8,820. So this equal to this. This was just what happened. But where the mistake I said we made was from here, because benefit to the shareholders is not post-merger, it's post-merger value per share, which is this one that we got, minus value per share of Kings. It's not of Queens, of Kings. I'm correct though. Of Kings before merger. What's the value per share of King before merger?
3 naira 50 kobo.
3 naira. 50 kobo. 3.50. That's their ex-div price, Abi?
Yes, please.
So this minus this, what do I now have? What do I have? My co-host
0.75. 0.75. That's 75 kobo.
0.75 per share. That's what. So what this means is, okay, you know that whenever you dilute your shares, like if King PLC should dilute their shares, that is, if they give out more shares, they've diluted their shares now. Bami, what I'm saying is the maximum price was supposed to be 75 million. Now they are now paying 37.5. The shareholders, they've benefited extra 37 instead of them paying 75 million now. The shareholders have not benefited 37.5. But the risk of that 37.5 is them diluting their shares, of them giving out more shares. So what it now means is even if they should still give out more shares, this 0.75 per share is the benefit they will still make from it. That's just the simple grammar there. But this is the value per share. So you now say total benefit is equals to 0.75 kobo multiplied by what's the total number of shares that King has?
50,000.
50,000 Yes. What's that benefit accrued?
The same half. They have
37,500.
37,500.
30 what?
37,500.
30. Where's that my calculator again? 30 37,500, I mean.
37,500. Yeah.
Trying to confirm something. I'm sure there are still questions, but at least that were 1,000 questions I shall left there. I'm sure some people will still want to ask something regarding it. But anyways, I will still take the question. Anyways, so you now say conclusion. Oh, if the takeover is as good as half of the price, this changes now. You know that the benefit, I'm coming on before I crack one joke, the benefits accrued to the to the shareholders of King PLC is equals to. You know the funniest part with this question is the answer was there from beginning. They just wanted you to, they knew that this was the answer from beginning because they're already paying half of the price now. Half of this 37.5 was what they paid. The other half is supposed to be their benefit, but all these workings, if you just at 37.5, you will not get anything. So the other half is the benefit that is accrued to them. So left to me, I don't think that where the problem is how to equate these things together. So if you just know this formula, market value over this half of the price, post-merger value, that is the total value you got over the issued share price plus X. As long as you can equate it like this, I think you will get your final answer. And as long as when you get to this part, they are equal to themselves, you have gotten it in a healthy level. So please, regarding this one, let me take, for the next 4 minutes, let me take questions regarding it also. So please, if you want to ask me a question regarding that, please raise up your hand, please. Please. Okay, so let me do this. 1 minute, please. This is hard. So I have 4 minutes to take questions here, please. Just 4 minutes. So yeah, these questions are too much. Mr. Tunde, I did say talk to me. Fast. Upper. Mr. Tunde, I did talk to me. Okay. Folashade, talk to me. I've omitted, people can talk
Oh,
now.
sorry, that was the initial one. Sorry about that.
Olatunbo, please talk to me. If you don't, this Mr. Yinka will be better person. Olatunbo, please talk to me. Balikis. Okay, so please, is there any question regarding this one that I did now? Is it clear? People are not answering me. Oh. You can unmute and talk to me now. Is it better? Is it clear?
It's better now.
Thank you. Thank you. So now I know some people just joined, so you might be struggling with what's happening here. What are we doing? So what we are saying is, please go ahead and watch the previous videos. That is, I've only solved 3 questions. So go ahead and watch 3 videos so that you get what I just did now. But from now moving forward is a new question I'm going to solve. So you can focus on this class. After this class, go and watch those videos. If you have questions, come to my DM. Let's trash it out. So this one I just did, you can just leave it. So once you now go back, go and watch the videos. Then if you have questions, come and meet me. Thank you very much. So on that note, I think I can move on. What's happening here. So let's move on to the next question. Let's move on to the next question. Please, I think the next question is about forecasting. So forecasting is one of the topics that ICANN has been testing frequently this period. Okay, let me make everybody's mic again. Just, so forecasting is one of the topics that ICANN has been testing this period. And why is that? For an accountant, if informations are given to you, adequate informations, you should be able to prepare a proper profit or loss, a proper financial position, and also a proper what's the name now? A proper cash flow testing. So what they do is they give you information, they tell you the ones that are increasing, the ones that are not increasing, they allow you to project or prepare an adequate statements, either profit or loss, financial position, or cash flow from them. So that's what our question. I think question 4 is about. So please somebody read it to me, please. Or read it for me. No. Any grammar that's correct. Eka.
Okay. AB Limited is a private company owned by two families who started the business in 2009. The company produces organic food for distribution in the domestic market.
Somebody should help me with that question. The next question now, please.
I'm speaking. Can't you hear me? Hello? Hello, I'm speaking. Oh, can't you hear me? Hello?
Can you hear you now?
Okay.
I can hear you now.
Okay. AB Limited is a private company owned by two families who started the business in 2009. The company produces organic food for distribution in the domestic market using food products from a number of farms across the country. The company is experiencing a period of rapid growth, with revenue expected to rise by 15% in each of the succeeding 5 years after takeoff. The company is hoping to retain a profit margin, that's the PBIT divided by revenue, of 30% throughout the next 5 years. The ratio of working capital to revenue is expected to remain constant, in bracket, where working capital is inventories plus trade receivables less trade payables. Interest paid on the overdraft and bank loan are at 6% per annum and calculated on the balance outstanding at the beginning of the year. Corporate income tax is paid 1 year in arrears at a rate of 30%. For simplicity, assume 100% tax allowance for capital expenditure in the year in which it is incurred. In arriving at operating profits, depreciation is charged at 25% on a reducing balance basis based on year-end balances. Extract from the management account of AB Limited on 30th June 2014 as follows. We have the statement of financial position as at 30th June 2014. All figures assumed to be correct. We also have the income statement for the year ended 30th June 2014. All figures assumed to be correct. In continuation, capital expenditure plans are 200 million in 2015, 200 million in 2016, and 140 million in each of the years 2017 to 2019. No disposals of non-current assets are expected in this period. Shareholders expect an annual increase in dividend of 5%. Any fund deficit in the year will be financed by overdraft, and any surplus fund will be used to reduce the overdraft. However, with the increasing demand on the funds of the business to finance growth, the directors are concerned that the company may exceed the overdraft limit of 30 million naira. They may therefore need to negotiate an increase in the bank loan, although the bank has indicated that it would not accept a gearing higher than 70% based on the book values, where gearing is defined as non-current and current borrowings, which includes overdraft, divided by equity. The shareholders have indicated that they do not wish to inject additional capital into the business. You're required to prepare the statement of financial position, income statement, and cash flow analysis of the company for each of the years 2015 and 2016, and advise the company on the extent of additional funding requirements in that period. Note, note one, all figures in your calculations should be rounded up to the nearest 1 million. To compliance with accounting standards is not necessary since these are management reports. B, recommend and comment on actions that the company can take to close the funding gap identified in A above. That's all for the question. You're speaking, we can't hear you, sir.
Can you guys hear me?
Yes, we
Yes,
can hear
please.
you.
We just said it now.
I was not talking before. Thank you. Okay, problem done there. Network done the run and come back. Please do better now. Can you guys hear me now?
Yes, sir.
Okay. So that question get a CBO. That question get a CBO. Anyways, it's just for you to predict the not predict, forecast based on the information given to you, forecast the profit or loss. So what you will do is, according to the question, you're supposed to forecast for 2015 and 2016, if I'm correct. So you make, so the way forecasting generally works, let me tell you guys the way forecasting generally works. First of all, in all situations or in most situations, forecast the way it is given to you in the previous years. What I'm saying is, first of all, know that most of the information or all of the information given to you in the previous years will be in the next year. Yes, now, because they will give you a base year. A base year is the maybe last year or current year, say 2014 or 20. For this question, I think it's 2014. That's the base year. So what I'm saying is, for the next 2 years that you're going to be forecasting for all the information that are in 2014 in your profit or loss or in your financial position, they would also be in the new ones. It's just additional ones that will now be there based on information given to you. Forecasting is very simple. It's very, very simple. The only way forecasting is hard is when you need information from somewhere for you to fill up another place. Example, now if you're trying to calculate maybe your some of the information carried forward, you might need to have go and do maybe cash flow first or something. That's just where forecasting is hard. But apart from that, forecasting is actually very easy. Very, very, very easy. Just follow the principles and the informations given to you. So let's solve. Is what's the name of your company again?
ABPLC.
What's the name of that company again?
AB Limited. AB Limited.
Are you sure that I will not add one? Wait first. I made 3 boy calls. One person
But
has
she's
not
talking
spoken.
now.
Miss Fiti Adeoti, what's happening now? You've not spoken to us. I don't hear you, madam. I'm trying
My
to
network is not
make
good.
my calls. Fiti Adeoti, are you there?
My network is not good. Yes, I'm here. Can you hear me?
I did not hear. I'll never
Hello,
heard that since the beginning of this class.
She's speaking, sir.
can you hear
I've
me?
only
Hello?
I think his network is very bad.
Okay, please, can you guys hear me?
Yeah, we
Yes,
can hear
can
you.
hear you.
What do I do now? Which is network first.
But we can hear you.
I don't think you can hear us.
You can hear me now.
Yes, we can hear you.
We
Yes,
can
we
hear
can
you.
hear
Can you
you.
hear us? We've been hearing you.
Please, can you guys hear me?
We've been hearing you, sir. Can you hear us?
No, for the previous one, you people are hearing me 1 year after I've spoken. I would have spoken like 2 years ago before you will be hearing me. Is it better now, sir?
We are hearing you. Can you
Yeah.
hear us the same?
It's
Yes, I can
better
hear you
now,
guys
sir.
clearly.
Thank you.
Okay. So let's
But
continue.
your
Let me
screen
share
is
my
not
screen
showing
so we can
again.
continue from where we stopped. I'll share now. So we are supposed to predict or forecast the profit or loss, the financial position, and also the statement of cash. That's what we are supposed to calculate from the information given to us. I'm already seeing a lot of things in the chat box that wait till I want to do. What am I supposed? What am I looking for? No, please, what's the name of the company?
AB
ABC.
Limited. AB
AB Limited.
Limited.
My co-host, I need you guys' energy. Mr. David, don't the insult now. Please, let's prove him wrong. So, based on the information given to us first, let's do the income statement first. So you see, statement of profit or loss for the year ended 30th of June. Now, my co-host, please, you should run me through the format of profit or loss.
Revenue. Less cost of less
Less
cost
cost
of
of
sales.
sales.
Then you get your gross profit.
Your gross profit, or also your you can also call it your earnings before interest and tax, Abby.
Yes.
I'm listening. Continue.
Then you less your expenses.
Less your expenses. Part of your expenses, what is part of it? Your interest, Abby.
Yes.
Interest and other expenses, sir.
And another expenses. Thank you. So from that, you have your profit before tax, Abby.
Yes. Then you less your
So
tax.
from then you less your tax, then you have your profit after tax.
After tax.
After that profit after tax, what do they remove from it?
Your OCI. Your other income.
What do they remove from it, Nimoso?
Dividend.
No.
They remove
Okay,
dividend from it. Thank you. They remove dividend from it. After they remove dividend, what do you now have?
Retained earnings.
My students are ready. So after you remove dividend from it, you now have your retained earnings. Now that's the perfect structure we are going to use from your revenue to your cost of sales. But the good thing is for this information, so for cost of sales, we get our earnings before interest and tax. We remove our interest and all the expenses there. We get our earnings before tax. We remove our tax, we get our earnings after tax. We remove our dividend, we get our retained earnings. Then from there we move forward. So let's start revenue. Based on the let me move this a little bit backwards. Okay. So based on the question, what's our revenue for base year? What's our revenue for base year? Base year, when I say base year, I mean
900
2014.
million. 900 million.
And what is this? What is the story behind it?
The story is revenue is expected to rise by 15% in each of the succeeding 5 years after takeoff.
Yeah, see, the thing is, listen to me. Most of the increment is about 5 years, 5 years. But in the question, don't set question for yourself. Don't go and do 5 years. Question says do 2015 and 2016. Question does not say do for 5 years. So I'm just going to pick 2015 and 20. I leave the rest for them. So let me go that revenue by 15%. What do I have?
1035.
1035.
35. Go 2016 to by 15%. You are going 1035 now by 15. When I say go,
1190.
when I mean
0.25.
two things, let me correct two things there. Hold on, let me correct two things there. Number one is whenever you are increasing, for people that have never heard the word grow before, whenever you say the year grow, it means that increase it by that particular percentage. You can do it two ways. The way they said increase it by 15%, you can do 15% of I think 900. Abi, was it 900? Is it 900?
Yes, it's 900.
Yes, it's 900.
So you can do 15% of 900, whatever you have, add it back to 900. It will give you this thing. Or for the smart ones, just do 1.15. 1 point is you growing it. Just 1.15 multiplied by 900, you get this thing. So from this one, 1035 multiplied by 1.15, you get this thing here too. So that's what they did to get what they had. Now, for the next, according to our structure in the stuff, do we have any information to cost of sales, either in the format or in the grammar there?
No, sir.
No.
So let's close this down. So which one do we do next now? Earnings before interest and tax.
Interest and tax.
Yeah.
EBIT. What's the grammar with it? What's the story behind it?
A profit margin of 30% throughout the next 5 years.
So what's the 30% of revenue? So what's the 30% of this revenue? Some people might be telling me now that how do I know that it's 30% of revenue?
3111.
Hold on. Sorry, let me say something. People might ask, how do I know that it's 30% of revenue? It's written there now. The company is hoping to retain a profit margin, profit before interest and tax divided by revenue. That's what it's just saying now, of 30% through the next 5 years. So it's profit to revenue. That's why it's 30% of revenue. They even said it here. Okay, not yet, sure. Anyways, share 30% of revenue. And I'm not wanted to correct. For somebody that gave me this figure that was saying 1,190,025. Read the question. I'm begging you with the name of God. Be very careful with the question. The question says that, let me show you so that people know I'm picking it from my head. The question says, all figures in your calculation should be rounded up to the nearest 1 million. What it means is no decimal should be in your work. So either you round up, it's even round up, not round down. So just be rounding up to the nearest 1 million. So no decimal should be in your work anywhere. That's the meaning. So yeah, what's 30% of this thing?
311.
311. The second one.
357. 357.
57.
So what do I have? What expenses do I have?
None. They just give us dividend.
That's in the format. Now in the story,
Okay.
I heard something about interest.
Interest paid on overdraft and bank loan at 6% per annum and are calculated on the balance outstanding at the beginning of the year.
Good. Let me hold on. Let me look for that place that you said something. Let me explain something there. Where did you read that grammar? Okay, yeah. Interest paid on the overdraft and back loan are at 6% per annum. Fine. And calculated on the balance outstanding at the beginning of the year, which is very, very fine also. Now, not a problem, but the issue is overdraft is separate, bank loan is also separate, and they are all charged at the beginning of the year. At the beginning, don't forget. But the problem is, okay, there's not even a problem. Let's continue. So let's separate them. Let's say interest on bank loan. What's interest on bank loan? What's our bank loan?
160.
So 6% of 160 is what?
10 approximately.
10, 12.
10 for the 2 years.
So now let's not do interest on overdraft. Now, what's our overdraft for this year?
$20, sir.
So 6% of 20.
$1 million.
I hope people are getting what I'm doing here. 1 million. But so for the next
But
one
can
now,
you join the two and just tax once? Both bank
you
and
cannot.
overdraft.
Like I always tell you, I always complain about presentation. I always tell you guys about presentation. Please present your work. Let it be. I don't know. Let's just present it. This and this will not take you anything now. But just another reason why you would want to present it is this next one. Listen to me. In the grammar that you read, Ms. Chika, it said that charge all these things on opening balances. Now, for our loan now, loan is going to be what? Loan is a type of a non-current liability now. So that 160 is what we have been carrying in our books over time. So 160, 160. So our opening balance is still most likely going to be 160, as long as we don't collect additional loan now. People know now, and we don't pay out of the loan. Or we've not paid back the loan and we don't collect. I hope I'm making sense. So what I'm saying is your bank loan is a non-current liability. Now it's still the same figure that will be there. As long as you don't collect new loan that adds up to it, or you pay back the loan. So it's still the same figure. So you can easily charge. So you can easily assume that the 160 is still the opening balance of the next year. But for overdraft, if you read the question deep down to some point, they tell you that if they need additional. Is it there? Is not there.
You are speaking, sir. We lost you.
Let me read it. Let me look for it for you people. You lost me, Ke?
Yes, please. At a point, we're not hearing anything. I don't know if it's same for others.
Is it better now?
Yes.
Okay. So what I was explaining was I was saying that for bank loan, listen, bank loan is a type of non-current liability. So you can easily, what I'm saying is if the loan is not paid back, or it is not added to, maybe you collected more loan or you pay back, that 160 million will not change. Yes, now what you close with 160 million is what you open with it next year, as long as the figure is not changing. As long as you are not paying, there's no information that says the loan was paid, or so it's still that same figure. But problem with overdraft is a type of current liability. Yes, now bank overdraft is a current liability. So there is high probability that changes will happen to it. Yes, now it's a yearly thing now. So there's high probability that something will happen to it. So either it increases or it reduces. And if you look at this grammar, they now say that, however, with the increasing demand on the front of the business to finance growth, Directors are concerned that the company may exceed the overdraft limit of 30 million. Bam. So what this means is our overdraft now has now increased by 30 million. That's the meaning of the grammar. That they may exceed the overdraft limit of 30 million. The limit is just the limit. That they may exceed the limit of 30 million. So what they are trying to say here basically is the new opening balance of overdraft should include 30 million. Since increasing demand for funds in the business. So what it means is subsequently moving forward, our overdraft yearly might be increasing more than, like it might be increasing by 30 million. That's the grammar. That they may exceed the overdraft. They had a limit. So the answer that they may exceed that limit of 30 million. So what it means is subsequently they should, or only if other information says otherwise anyways, the overdraft limit should be increased by 30 million. And for 2015, we had closed 2015 with 20 million, Abi. So our balance carried forward for 2015 is 20 million. Our balance brought forward, for 2015 is 20 million. But our balance carried forward to 2016 is 20 million and this 30 million for the beginning of the year. That my grammar no clear. What I'm saying is before they had 20 million naira now as overdraft, which is still the same figure they will carry to the next year. They now still collected an overdraft at the beginning of the year of 30 million. That's just every beginning. They said that all these things should be charged at the beginning. So every beginning, what it means is subsequently you'll be collecting 30 million. So if you had 30 million to the 20 that was on ground before, we had 50 million. So what it means, if we're supposed to do 2016, you're supposed to now have what? 80 million. You get it?
So it's confusing, oh.
Let me come again. What I'm saying is, or leave the grammar. What it means is, leave the old English is English, but what it means is every year they would be passing the limit of 30 million. That is, be increasing their overdraft. Overdraft is a yearly thing now. It's not like bank loan. Bank loan cannot just be increasing anyhow. Yes, now since it's a long-term liability, there's a years attached to it. But overdraft is a yearly thing. So that line is simply just practically telling you that every year, be increasing your overdraft. That's the limit. Be increasing your overdraft by 30 million. That's just the grammar. Before now, we had 20 million for 2015. So what it's simply saying is 2016, add 30 million to the 20 million on ground. That's 50 million. If they were supposed to do 2017, you would have had what? You would have had 80 million. That's 30 plus the that's 20 of 2015, 30 of 2016. Then you're supposed to do 30, if you're supposed to do 2017, 30 of 2017. That would have given you 80 million. That's what you would have had for your overdraft. Koye. Ms. Chika, is it better? Is it better now?
It's not clear because for me, from the question, the way I deduced it is this: that they have a limit of 20, but they are expecting it to pass that limit.
But that's the way you deduce it is not correct. It's not correct.
Thank you.
Now,
thank you, sir.
The way you deduce it is not. Now let me explain it again somewhat. The thing is, look at it from this perspective of if you read the way you read the English now, that the company may exceed the overdraft limit of 30 million. The overdraft limit of that particular 30 million, the 30 million there is just a cap. When I mean a cap, it's just like a, what do we used to call it in economics again? Like if we used to call it one name. Is it benchmark for floor? Like a benchmark, something like that. Okay, they should not pass this 30 million. That was just what the overdraft limit said. That overdraft limit, that's just the only grammar is passing. That they had a limit of 30 million. But usually, normally, an overdraft will be going. Overdraft is a yearly something. So normally, even without this overdraft limit, overdraft figures are expected to be changing because it's a current liability. The same way your tax payable would always be changing. Yes, now because it's a yearly something. The same way your receivables, figures for your receivables will always be changing because it's an item of a current asset. The same way your item of a current liability will also be changing. So this 30 million that is just saying is just that, okay, they may pass the overdraft limit of 30 million, but the limit was not given to you now, so you cannot assume the limit. May exceed the overdraft limit of 30 million. That is the 30, God of mercy. The amount that it changes by is 30 million. So they're just telling you that, okay, if they want to increase it, they may pass it by 30 million. But they did not tell you that there's no information that says did they do increase in demand on funds? Did they do finance goods? I don't know if I'm making sense. So let's start from here. However, with the increasing demand on the fund of the business to finance the goods, directors are concerned that the company may exceed the overdraft limit. Is there information in this question that told you about them increasing demand for funds? Is there any information that told you that they finance their goods? Maybe the only condition is if they finance this goods, they will pass this limit. But there's no information that told you that they did all those things now. But what this information is just telling you is they have an overdraft limit of 30 million. That is just the only one I want you to hold there, that they have an overdraft limit of 30 million. So what it means is every year, add 30 million to the current overdraft. That is just what the grammar means. Add 30 million to the current overdraft. Thank you very much. Please, if you have your question, write it down. I'll take them later. So for the previous one, we had 20 plus 30, that's 50. So please, 60 million of 50, 6% of 50 million gives me what?
3 million.
3 million. So what next? What next do I have there? So let's get my profit after tax. So profit. We don't have any other expenses now.
None other, sir.
So that was my profit before tax, sorry, not after tax, so before tax.
First year is 300.
300. Second year, go.
Second year is 344.
344. Now let me charge my tax. What's my tax rate? What's my tax rate?
%30.
What is my tax rate?
30%.
20. 30%. Thank you. But the problem now is you cannot charge this tax directly. Yes, now. Why can't you charge it directly? You cannot charge it directly because, see, whenever I can ask you whenever they ask you, let me give you guys a trick. Whenever they ask you for forecasting, what you're supposed to do with forecasting is basically put yourself in auditor's shoes. That's just the meaning. Just like you reviewing the books. Now, this tax now, you cannot charge tax on this profit before tax. Now, why can't you charge that? You cannot charge tax directly on it because calculation of this profit before, a lot of things is involved already. You know the way you calculate your tax now, where you do, what's the name? All this, your profit, you add your capital allowance, you do, you less your capital allowance, you add back non-cash item. You know that, okay, don't let me go through that. Let me go through this route. Maybe you know that there is difference between taxable profit and accounting profit. I know you know. But if you don't know, there is difference between accounting profit and profit. Accounting profit is the one me and you used to do in our organization. But taxable profit is the one that this tax pool will come and compute for you. So what they do with it is they carry your profit before interest and tax, bam, they take it like that. They now less, they don't allow depreciation, but they allow capital allowance. So they're not going to calculate capital allowance. They now less capital allowance from it, bam. So once they less capital allowance from it, they add back your depreciation and other non-cash items. All these them normal interest, they subtract. They now get their taxable profit. They now charge tax on taxable profit, and that's the way that we do forecasting. Don't charge tax on accounting profit. Charge it on taxable profit. Are you listening to me? Don't for forecasting. For other ones, fine. But for forecasting, don't charge your tax on accounting profit. Go and charge it on taxable profit. So it leads us to what? Leads us to working zone. Working zone. So you say workings. People will be saying, where am I bringing all these demonic questions? I could easily have brought simple questions, but I'm not helping you people. I'm not helping you. Let's bring out all these ones that I know that if you see an exam, you go choke. So let's start now. So let's say calculation of tax. So let's say so you say 2015, you say 2016. So you say PBIT, what are probably before interest and tax for 2015? 311,357. People have left me to it though.
We are here with you, sir.
Less capital allowance. What's capital allowance in the question? What's capital allowance in the question?
Capital expenditures are 200 million in 2015, 200 million in 2016, and 140. No disposals are expected in this period. But they didn't say capital allowance.
No, listen, come back here. See what they see the grammar here. They said that for simplicity, assume what? 100% tax allowance for what? Capital expenditure in the year in which it is incurred. Listen to that grammar. That's what I always tell you. See, read to understand. Read line by line. Assume 100%. So what it means is on that capital expenditure, assume that is the whole amount that is allowed for tax. Yes, now if they are told you 75%, go and take 75% of 200. If they are told you 60%, go and take 60% of 200. But for this purpose of this question, they said assume 100% tax allowance for capital expenditure. So you assume that take the whole figure for capital allowance. So you now come here and say 200. How that's fine.
Yes, please.
Okay. Next one. So let's go and less all those our interest too. Interest on what's the name now? Interest on bank loan.
Over.
This one was 10, Abby.
10 for the 2 years.
Interest on bank overdraft. This one is 1. This one is 3, Abby.
Yes, sir.
Now let's go and add back depreciation and other non-cash item. Do we have amortization there? Add back
No, sir.
No amortization.
Item. Normally, there is no depreciation also, but from the back of your mind, you know that for something to have capital expenditure, obviously, it has depreciation. Add back depreciation, which leads us to what? Workings 2.
Workings 2.
So you come here, you say 2. Calculation of depreciation. Now, so you come here again. Some people don't. Don't worry, it gets better from here. I like Shabbat. Let me give you. So you say PPE. What's the value?
$300 opening balance, please.
300. For 2016, it didn't increase by anything. Is there any increment to it?
100 now, the new machines, the new capital expenditure that we buy.
Let me see where you are picking the figure from. Okay, 2014. Or where did you pick the 300 from?
The 300 is from the statement for 2014, sir.
Good. Which is so yeah. So what you are assuming is the closing balance of 2014 is the opening balance of 2015, since there is no other information to it.
Yes, please.
So if there was any other information that says, okay, maybe PPR has grew by something, you can easily go and grow it. But there's no information that says that it has increased, they have sold. So just assume that it is still that same figure over time. So you come here and say 300. You now come here and say capital expenditure. Capital expenditure. I think it was 200 now.
Yes, it is 200, sir.
So you now say total can you now? You say total what's the name now? Just say total or total
PPE.
total
Total
PPE. That works. So you call it 500. That's 500 in total. Charge your depreciation. What's depreciation rate?
25% on reducing balance basis.
So if it was straight line, listen, if it was straight line, just come and divide this 500 by the number of years. By 2 years or 4 years, depending on the information that is given to you. But since it's reducing balance, just say as 20% or 25%. Sorry, what do I have? What do I have?
125.
125. So this is my PPE carried forward. What's my figure?
$375.
375. So this PPE of 2015 carried forward becomes my PPE brought forward for what? 2016.
2016.
It's a 375. Capital expenditure is still going to be 200. So in total now, I think I have 575. I'm correct. Please confirm figure. Is eye contact I'm doing? 575. Depreciation at 25%. Give me 25% of this. 134. Am I correct?
143, 144.
144. So what's my PPE? What's this one's figure now?
$431.
431. So we've gotten our PPE and our depreciation carried forward. So let's put this in our our depreciation here. No, not okay. No, we've not gone back. We are still here. We've not gone to our normal work. It's tax we are trying to calculate. We've not gone back there. We are still here. So come to your depreciation here. What's the value of our depreciation? 125 and 144. So you add back 125 and you also add back 144. So once you've done that, I think you are done for that. So say I think that should be all. I think that should be all that we have there. No, what am I doing here? I wish you have not made a mistake. So you have made mistake now. You did not correct me. Okay, no, there's no mistake. There's no mistake. We are still correct. We are still correct. We are still trying to add back depreciation and before we get our tax. What we are trying to calculate is taxable profit. Abi?
Yes, sir. Yes, sir.
This division we got here, we put it here for calculating of taxable profit. So we've add back our depreciation now. So let's get our taxable profit. You could arrange your own, hold on, you could arrange your own anyway. Just try to understand what I'm trying to do, please. Listen, let me explain again. We've gotten our profit before tax. So what me I'm telling you, you cannot charge your tax on it. So you need to calculate your taxable profit before you charge your tax on it. And the format to calculate taxable profit is your profit before interest and tax, you less capital allowance. Capital allowance in the question, capital expenditure was 200, and they told us to take 100% of it. So we took the old 200, subtracted it. Normally, the way you calculate your normal taxable profit now, less your interest, less your bank overdraft, if there was amortization add back or non-cash items. Part of our non-cash item was depreciation, which is 25%. Now, the 25%, now we needed to go and calculate the 25% of the depreciation. Now we need to go and calculate it on the particular assets. The figure was not given to us in the question now. It was just the percentage. Percentage of what? 25% of what? That's what now brought us to this place. So we did 300, which is our PPE in the question. Capital expenditure is our 200 in the question. Total PPE now is 500. We charge our 25% on it, so we know that okay, our depreciation for this year is 125. This is our PPE carried forward. We brought this 375 to this side, which is our PPE brought forward. Got our depreciation for the 2 years. So we are taking our depreciation now back here to go and calculate our taxable profit. What's now my taxable profit? I'll take question when I'm done with this POL, please. What's my taxable profit? Yeah. I'm coming. I'll take questions. Please hold on. What's my taxable profit?
225 for 2015 and 288 for 2016.
225, 288, I mean? Like
Yes,
this?
sir.
So you now say
288.
And that's what I wrote now. So you now say tax at what now? At I think you said 30%, have you?
Yes, it's
Yes,
30%.
please. Yes, please.
What's this 30% of this?
68 and 86.
68, 86. Global down. So these are our tax. So we'll take 68 and 86 back here. 68, 86. Somebody help me do 30% of this 300. What do I have? This one is about 100 now. No. About 30. What's 30% of 300? 90-ish.
So you said what?
Somebody help me do 30% of 300. That should be about 78, 90, about 90. 10% of 300. What do I have?
90.
What I'm trying to say is, so for people that do not do taxable profits, you would have subtracted 90 from here because you would have done tax rate of this thing, which is wrong. So go and calculate your taxable profit first before coming here. So once you are done here, you will now say your profit after tax, Abi. What's my profit after tax? What's my profit after tax? What do I have? Someone should be doing 2015, someone should be doing 2016, please. Yeah. I think I should add more ants to this my co-host. Please hold on, let me add more ants to this my co-host. Patricia, your calculator, Abi. who had you before? Okay, sorry, everybody is muted. Okay, so let me make Patricia also a co-host. Please help me with calculating. Patricia. I want to find your name. IJKLMNOP. Okay, so I'm making you also a co-host. Okay, so you can call figure for me too. Thank you very much. So what do I have, please?
Sorry, that tax should be deducted. Am I right or wrong?
Yes, you are right.
Okay, so that is why I got 157 and 202.
Miss Patricia, is that you?
Yes, sir.
Cannot get 10 now. This is 300 minus 68.
I said
You
157.
cannot get one anything. This 300 minus 68. It should be 220
Okay,
something.
sorry.
232,
232. 232.
232,
Madam, you just come. Madam, you just come and I don't cook this for us.
258,
I beg you.
258 and 232. 232 first, then 258.
Miss Patricia, are you for us or you are against us? Just now, you
Sorry,
want
sir.
to just now, you
Sorry,
want to
sir.
poison us.
I'm for you, sir.
I beg you. So, what are dividend, please? What's 2014 figure for dividend?
200.
What's the increment?
15%.
15.
Annual increase in dividend of 5%.
Yeah, what's 5% of what was there before? Yeah.
Should be 210.
210.
1.05
210.
200.
Second year, go.
221.
221.
2-1. So let's do this now. So yeah, put that one. So you now say is that so you now say retain earnings. Retain earnings. Because when you get to retain earnings, you need to be careful because retain earnings is like you need to like balance both forward and all those things. So what's retained earnings I have for this one now? That should be 22, if I'm correct. Abi?
Yes, please put your dividend in brackets.
Sorry.
Yes, 22.
So you now say retained earnings brought forward. What do I have? What's retained earnings brought forward now?
Is it not
But
22?
for this year,
80. Is
for
it
this,
in the
no, this
one in
retained
the
earnings, this
SFP?
is retained earnings for 2015 brought forward from previous year, from base year.
80.
SFP is 80. 80.
80.
So you now have, so what is my retained earnings carried forward now? People that not do FA in foundation. Here it goes. So
That should be 102.
this basic
22 plus
accounting.
80, 102.
So you take this 102 and come and put it here. So this is my sorry, no, okay. So what's the retained earnings for the year here?
37. 37. 258 minus 221. 37.
37. So what's my retained earnings brought forward? That's 102 now, Abby.
Yes.
102. So what's now my
That's
retained earnings?
total is 139. Total 139.
Go back down.
Please put your 221 in brackets as well for dividend.
Okay. Yeah. Oh yeah. Real quick. Let me take small question. Just small. There's not plenty too much. There's not plenty too much. Yeah. So please, those are plenty. Want to ask me anything? Real quick. Fast. I'm taking few questions for 3 minutes, please. Just few questions regarding profit or loss. Oh yeah. Mr. Lucky, you almost injured me. Now I can hear your question. Fast.
Good evening, sir. Can you hear me, sir?
Yes, please.
Okay. I have just one question or two rather. The
Ask me.
profit before interest that we use in solving or getting the tax. Can't we also use profit before tax because lessing the interest again will still give us that same profit before tax? Will they penalize us if we just pay profit before
No,
tax?
no, anyone that is comfortable for you, anyone works. But
Oh,
just be very, what's the name? Grammar, English has gone away. Shall be presentable, like be
oh,
detailed. Hey, that's what I'm trying to say. But like you can do it anywhere. You can do it
no.
anyhow you're comfortable with.
Okay. And in solving this question,
I know hear you again. No, it's my network. You are muted, sir.
No, we lost him.
You lost him. Now, wow.
Please find him more.
But him is muted. Mr. Lucky, you've muted yourself.
sorry, no, I actually left the meeting. It sent me out of the class before. Well, I'm back now.
Oh, yeah, ask
Yeah,
me.
I was saying, must you follow this pattern of statement of profit and loss before the statement of financial position, before your cash flow, you can intertwine or do anyone that you think is
No, don't do anyone. No, start from your profit or loss first. Then
okay, we
balance,
must
then
start from.
financial position. It's not we must. There's not a rule to it, but like if you understand forecasting very, you understand that there are some information that you need in balance sheet that is from profit or loss, so you can carry them, and there are some that you need
Yes.
in balance sheet that is from cash flow that you can carry them. So just do it in that format. So it's easy to go and pick information from the one you've done before.
Okay, thank you, sir. I'm good.
You're welcome, Mr. Kayode. Please fast. Oh yeah, oh. Miss Chika is a mistake, are we?
It's not a mistake, sir. We are asked to do tax in arrears. Is it not applicable in the POL? Please.
For this particular purpose, if we are doing tax, you know that will not do tax in arrears because we charge that tax on what? On our taxable profit. When we're doing when we're doing our statement of cash flow, we'll take care of it there because that is the way the flow of money is going. But because we did not charge it on our accounting profit, on our own profit, we cannot account for it now. We will not take care of it. We charge it on our taxable profit. So, but if we are doing statement of cash flow, when we are doing statement of cash flow, the way we pay the money, the other one is our own business. It's the way our own money has gone out, and we'll take care of it there. But for profit or loss, because it was charged on taxable profit, we calculated our taxable profit first before charging it. So we will not charge it there. Oh, that's fine.
Thank you, sir. Yes, sir.
Uchechi, question, fast. I'm done here. Uchechi, okay, real quick, please, your question. Okay, I'm hoping that was a mistake. So let's continue. So let's do statement of financial position real quick, please. I still have another big question I want to solve today. Oh yeah, this one is statement of profit. So let's go on statement of financial position. The rest are simple. This is the only one that is a little complicated. Statement of financial position. Position. Yeah, what do I start with? Let me say as at 30th of June. So what do I start with?
Non-current assets.
Non-current assets.
So what are the non-current assets I have in the question?
You have
It's just a
opening
line
non-current
item.
asset. 3.
So let's do like this. Let's just say let's say non-current assets. So let me see. I think I have PPE now.
Yes.
So what was the figure? What have figure we calculated now? This is the figure.
Sorry, it just means that your screen is frozen. No?
Frozen, okay. Is it frozen? Check, please.
300 PPE, we calculated 300 for 2015 and 375 for 2016.
No, it's 375 for 2015. See it here. Then
Yes,
431.
Okay, they carried.
Yes, it's the carry forward.
Okay, okay.
This is the one that this is the one that after everything, after you charge your depreciation, this is the total value for 2015. This is the one you now brought it. So you use this and this. So 375 and 431. So you now say 375. That's why I was telling person that asked me that question. I've forgotten the person now. You see that there are some informations that hey, if we didn't do that one, where would we get this one from? Although you can calculate it aside anyways, but I feel like it's now more confusing. So let's do our working capital. Working capital. So what's the grammar on working capital, please? What's the grammar on working capital? Yeah. What is the English on working capital? I'm not hearing anybody.
The ratio of working capital to revenue is expected to remain constant, where working capital is inventory plus trade receivables less trade payables.
So they said the ratio of working capital is expected to be constant. I can. Wicked people. Now, they say ratio. Where is the ratio in this question now? Ratio is nowhere to be found. How do we not get the ratio of working capital? Somebody just look at that and think. Let me plug my system. Give me 2 minutes. Just be looking at it and tell me how I can get that ratio. Please, 1 minute. People know that if my laptop is low, that's a reason to end the class. But if I don't plug my laptop like this, we day here to 3 a.m. Look at chat first.
60%.
Now don't you cook?
I think if we go to the body of the question, we will see some figures
Yes,
and we can work
60%.
it out.
And
20%. Hello, sir. Can you hear us, please?
I think we lost him.
No, please go and find him, please. Please find him. SFM is dealing with us.
I think he's out of the meeting, sir.
can you guys hear me?
We can hear you now, sir. Welcome back, sir.
How did you get 20%?
180 divided by 900.
Yeah. For people that picked 20%, you people are the best. Thank you very much. It's 20% now. Easy. Go to 2014 figure. They said it's a ratio of working capital to what's the name? It says a ratio of working capital to revenue. And just go to the 2014 one now, then do ratio of working capital to revenue. Let me share my screen. So you just come here, bam. Say 2014, no, working capital 180. Revenue is what? What's revenue?
900. 900.
So do 180 divided by 900. It gives you the ratio now.
0.2, which is 20%.
And they said it's constant over the year. So you use 20% for the 2 years now. So yeah, 20% of revenue for 2015 is what?
207.
207. For 2016, go.
238.
38. Please, if you have raised up your hand once, it's okay. I would just leave it like that. I'll answer when I'm done. If you are raising up your hand several times, the ton, they frustrate me. So yeah, what's next? So what's my total? Something like 582.
For 2016 is 669.
669. Yeah, our equity.
582. Okay.
I'm writing down by myself. So these ones, I don't think there are any changes to them. Usually they don't used to be changes to them anyways. Our share capital, what was it? What's our share capital in the question? Oh. Share capital in the question.
200 million. 200.
I think one class like this, maybe next class, I'll just make men. I'll make men my co-host. Let me see the way it works. Let me see. Let me try it first.
Sorry, sir. 200 million.
You are slow today. Yeah, next one. Retained earnings. What's my retained earnings?
80 million.
102. 102 and 139.
Okay, yes, we did workings.
139.
139.
So let's do our non-current liabilities. One question. Go that big go. Now one chapter now. Non-current liability. Bank loan. What's my bank loan? 160.
Our bank loan remains 160, 160.
Bank overdraft.
Nadia will go do calculation.
Bank overdraft. Now, for this bank overdraft, some people could easily have made the mistake of saying what's the name? Of using any of the ones anywhere. You could have said maybe you want to use 1, 3, or you want to use 20 or 30. No, you cannot. You cannot though. So this is what you will now do. So once you get there, you will now say, where is it again? So you now say, I want to correct them now. Anyways, you now have to go and do your statement of cash flow first. Your statement of cash flow that is one that will show you the amount of your bank overdraft. So you now come here, you say statement. People should better not pay for cash. For cash is simple, sure. Statement of cash flow. No, the thing is why I said it's simple is even the basics that you did not know, I'm sure you would have written something. You would have just lost mark there, but you cannot get 0. That's why I love business valuation. You can easily get 0 in business valuation. Like not like if you've not attended my class is what I'm saying. But if you've attended, I'm sure you have explained the basis of where to start from. But if you don't know where to start from, you can comfortably not do business valuation question. Yes, now as you don't even know method to use, what thing you want to do? If you use method to use, you don't even know formula. If you know formula, you don't know, let's say maximum price, you don't know the formula for maximum price. Synergy, you don't know formula for synergy. What do you now want to do? Can you comfortably get zero? But for forecasting, your eyes saw it there that to do profit or loss, do financial position, you know the items in profit or loss. Revenue, they told you there is 15%. This one, they said it's 30% of this. Bank loan, this one. It's just over there. Some of you might have made mistake. Fine. You might have used 1 which you would have worked. You would have gotten this tick. Profit before tax, you would have gotten it correct. You would have missed this tax comfortably. You would have gotten dividend. Do you get what I'm saying? You cannot get zero. You cannot. You cannot get zero. So that's just the fun part, anyways. This overdraft now, some of you might have gone to the one we did and put the figure there. This is the only tick you will miss. You would have gotten the rest. But for business valuation, comfortable zero like this. Anyways, let's continue. So you say 2015, 2016 background. So people that did cash flow in school, in FR or CR, help me. So your earnings before interest and tax. What was it? What was my earnings before interest and tax? Yeah.
311 and 357.
357. So let's add back our depreciation.
125 and 144.
125.
1 and 144.
So you now see working capital. Our working capital, was there increment or decrement?
Increase,
How did you decide if it's increase or decrease?
from your statement of financial position in the base year, and you check from the new year. That's
For
2015 minus 2.
For 2014, how much was it? For 2014, how much was it?
180.
180. 2015 is now how much?
207.
That means an increase now. And please, whenever your working capital increases, please deduct it. Increase in. What's the difference, please? What's the difference?
27.
27. That's the amount of the increment. Subtract
Yes,
it
please.
from the 2015 and 2016 income.
31.
31. So what's my net cash flow from operation? It's a net cash flow from
2015 409.
So hold on, please let me move all these ones back a little. Let me write this depreciation in full. Because somebody will ask, come to my DM and say, what is the meaning of depreciation? Or what's the meaning of WC? At least working cap is still better now. That one is still clearer. Oh yeah, net cash flow from operation.
Oh, 9.
Four 70.
First one is 409. Second one is what?
470.
470. 470. So let's do our interest and all those things. No, it should not be. So come here. Say interest paid. What are interest paid? 11 and 13, have you? I've added them together here.
Yes, please.
13. Yeah, dividend. Two ten and what?
221.
Tax paid. So this is when you now do tax paid in arrears. Because this one now is cash flow. Money is going out, gone. So this is where you account for it. So what was the tax I paid in 2014?
20.
So 20. So you will be charged in 2015. The one I paid in 2015 will now be charged in 2016. How much I
68.
paid?
68.
68.
So you also now come here. You now say capital expenditure. Capital expenditure. 200 of it. So what is my net cash flow?
$168 for 2016.
Huh? Don't give me 2016 figure yet. I don't even think it's correct. I cannot have 168 now. Say 200, 221. Give me for 2015 first.
For 2015, sir.
Negative
For the
21.
operation,
Negative thing.
32.
Negative 21.
Well done.
Oh, sorry,
32.
please.
32.
Please, sorry.
2015, 32. Negative 32.
So once you are now done there, you now say overdraft, brought forward. How much was the overdraft that was brought forward in 2015?
20 million.
20 million. So what's now the overdraft carried forward?
52.
Overdraft carried forward. You see that if you had used 20 or 30 there, you would have been wrong. So you need to calculate this one first.
Very wrong.
So you now bring your 52 here. Bam. Sorry, what's this one? This is not where you bring it up. What's your net cash flow? This one is net cash flow. What's your net cash flow?
Is 32 too.
Okay. Negative 32. So you now come here. So you now bring your 52. It's negative, but don't forget. So what do I have?
82. 84.
So that is so you've used one stone to kill two birds. So like this, you've calculated your statement of cash flow and you can pick your overdraft comfortably. So carry this your overdraft here. Bam. So you put it here. You say 52. You say 84. Abi? What do we have? We have tax payable. What do we have last? Even though this thing was balanced, if this thing no balance like this, that's the end of. What do we have last? Tax what? Tax payable. What's our tax payable? What's the tax? I think 60 written. 60 what?
68
And
and 86.
let me calculate my equity and my liabilities. So, do I have the same thing as what I have in my assets? If no balance, I go leave them. I can promise you people that. Total equity. What do I have for 2015?
I'm getting 378. So
Balance,
somebody should
balance.
At the year 370, can you count 370 what? Please confirm the figures. What do I have? Oh?
Correct.
So
They all balance.
So
So
582,
it's correct.
669. There's no way you are doing it in the exam that we balance. Make I no lie for you. No juju. Me that I did it now. If I do them for exam, you no go balance. So just do them, leave them, and move on with your work. His attempt is not solved. You are not the one that assess the question. He said attempt it, did not say solve it. Person will solve question, don't feel no fee solve them. So attempt it today. Thank you very much. So please ask me your question. Yeah. Before I do another question, I have another question I want to solve today. But before I take question, let me turn people's microphone on. Now let me hear your opinion. It's simple. What do you guys think? Not simple.
So this is not simple, but with practice it will become simple.
This
But
is
as
like
you said,
no.
Practical.
as you said, sir, you cannot get zero. You can't get zero with this, as you said. At
Cannot
least
get
you
zero.
see where you can fix in one or two things. Maybe you can get some wrong, but you cannot get zero.
You cannot get zero. I beg, Miss Angela, we think begin go. I just the year different things today. Which one begin go again? God, I beg go. I have another question I want to solve. Please ask me your question real quick. But I will still take a question from the chat box. Uwala, please ask me your question, please.
Yes, so the first question I have is the profit before interest and tax. It was it was okay. Yes, I was lost when we were doing that side. So how did we get the figures from the 30%? I heard when we were saying something about 30%, but when I did it, I was not getting the same
Which one is that
figure.
again?
The profit before interest and tax.
30% of this thing now.
Oh,
Oh, fine. You said it's
yes.
30%
And
of
the other
revenue.
one,
30% of revenue.
yes, I just tried it again. The second
Oh, yeah.
one is the working capital. How did we use the 20% to get the 207?
You look like magic. I mean, like say we do abracadabra. If you go to the question, they said it is a ratio of working capital to revenue, and they did not give us the ratio. So we just went to 2014 at the base year. Then we divided the working capital by revenue. So it gave us a percentage, and they said it's constant over the years. So we just use 20%. Since the first one gave us 20%, so we just use 20%. So what they did was, now them do amu. What they did was 180 divided by what's that revenue again? I think 900. I'm waiting. 900.
900.
So you give them 20. Now, since they said it's constant over the years, they just use it like that. I will find out. So like, oh, good.
Like after getting the 20%, how do we use it to get it 207? Like
Charge
I'm
it
not
on revenue.
understanding.
Charge it on revenue. Charge it on revenue. Is a ratio of revenue now. So just start 20% on the revenue.
Thank you.
Mhm. You're welcome. So what I would want you guys to do so that you don't get confused, I should have done it for you, but I don't think I have that strength. Come here, maybe in your book, write something like, say, maybe comment, so that you will not forget.
Thank you. I get it now.
So that I don't stutter. It's in all these things where they try to avoid. It's fucking up. So what I was trying to say is just come here somewhere like this, do comments, so that you understand what we do better. So here you can say 15%, 15% growth, so that you don't forget. Here you say what did we do here again? I think 30% of revenue. Don't start there. You understand what I'm saying?
Of revenue.
So try to do something like that on beside side, maybe in your book or somewhere. Or when I send you the PDF, convert the PDF to Word, so that you can be able to edit it. For people that use soft copy, for people that you are writing it, go and just write comment behind, so that you don't forget what we did there. Yeah, let me take one or two more questions, please. Miss Edina, talk to me.
No, it's on the working capital, but you just explain it now. So the 20% now will not be on the base revenue. It will be on the 2015 revenue.
On the 2015 revenue, the base revenue was just to get the 20%.
Okay.
But for 2015, you charge it on 2015 revenue, 2016 on 2016 revenue. Since they said it's constant, in some questions they could have told you that they can say that working capital, and they now say it increased by 5% over time. Now, the question has changed. Yes, now. So what you will not do for that kind of scenario is just determine the base one to be 20%. Just increase that 20% by 5. So that's the one you use for 2015. Increase it by 5 again. That's what you use for 2016. It's the question that determines what you will do. It's the question that determines what you will do. It's not. Anyways. Any other question? Mr. Jamil, talk to me, please, real quick.
Yes, sir. Thank you very much, sir. I have two questions. It's like you explained this revenue working capital. I didn't get it clearly. And the other one is on this interest on overdraft, this 6%. How do you get this 1 for 2015 and 3 for 2016? I didn't get it clearly.
This working capital now.
I have to compute the working capital because I punched my calculator like countless times. I didn't get it.
Now, it's English. It's English. You people should go and shoot your English teacher. All the people that taught you GS, go and shoot them. It's just grammar. They said that the company is open to maybe a deal. Yeah. Okay, they said that the ratio of working capital to revenue is expected to remain constant. Now, they have told you that it is a ratio of working capital to, when they say something is a ratio of something, net profit margin. Maybe is your net profit that means your revenue ratio to your net profit. Now your net profit to your revenue. So there's something is working capital to revenue. So it means divide your working capital by your revenue. That's just the meaning. But then I said it's expected to remain constant. But we don't have that particular ratio. Yeah, they did not give us their ratio part. So we needed to go and get that ratio first. So in order to get that ratio, we came to the base year, divided our working capital of the base year, which is 180, by the revenue of the base year, which is 900. So 180 divided by 900, they give us 20%. 180, press it now. 180 divided by 900, it should give you something like 0.2. That's 20%. So, and they now still said in the question that it is still constant. It remain constant. So it means that I use the 20% over time. So just keep going, just keep using 20% of revenue. That's the meaning. So it means that the ratio of working capital to revenue is 20%. That means that out of your revenue, the meaning of that is out of your revenue, you're removing 20% for working capital. Somebody's unmuted. No, don't start. Just now. Uchechi, just now that I unmuted everybody, you people have started. When they say that, the meaning of that 20% ratio is that for all your revenue that you make, 20% out of it is your working capital. Normally, that is the way it is now. There's always, even in real life scenario, there's always a percentage of your income, of your revenue that you use as working capital now. If you make 1 million, is it all the 1 million that is profit? No, now, make 1 million in 2015, you remove maybe 10%, 20, okay, this is the money that we use in operation for next year, money that we use to buy fuel, that we used to buy office paint, that we used to buy printing paper. Those are your working capital. So you remove a percentage of your revenue from it. So that percentage was what we did not know for the first time. So now went ahead to do this division, give us 20%, and they said they remain constant over the years. So we just pick 20% of revenue. So pick 20% of 2015 revenue, you get your capital. 20% of 2016 revenue, you get your working capital. And about the overdraft, what happened with the overdraft was we said that always use opening balances of the overdraft. Opening balances of the overdraft. And for the first overdraft, for the first year, we had 20 million. And because as 24, this is the closing balance of 2014, as you can see here. And the question says that we should use opening balances. Is here, it's not me that said it. I was standing at the beginning of the year. So if this could be the closing of 2014, it means it's the beginning of 2015. That's the meaning. So 20 million was the beginning of 2015. So if we do 6% of 20 million, it should give you 1 point something, 1 million. Now for the 2016, I'm not telling you that for every year, for a current liability, the figure is expected to change as long as there's information to it. The figures are expected. It's a yearly something now. And this grammar now came in and said that the director at the company may exceed overdraft limit of 30 million. So I'm telling you that what this grammar simply means is every year the increase their overdraft by 30 million, that they may exceed the limit of 30 million. So what it means is just increase the overdraft by 30 million. So they had 20 million on ground as closing balance before for 2015. If you had 30 million to it, that means the overdraft for 2016 now is 50 million. So if you charge 6% of that 50 million, it should give you 3 million and something. So if there was 2016 or 2017 in the question, the overdraft would have been 80 million, which is 50 before plus this new 30. Only if information says otherwise. But the way it is like this, you would have had 50 plus 30, 80. You would have done 6% of 80 for your overdraft of 2017. If that's clear, sir. Jamil, Chulo.
Okay, thank you, sir.
You're welcome.
Thank you. I get it.
Yeah, my mouth done the pain me. Coyote, please ask me your question.
Well done, sir.
Yes, ma'am.
Yeah, please, I initially have 2 questions, but one of it has been trashed with the last person that asked question. But I want to look at the second paragraph of the question. So there is a place that said the company is hoping to retain a profit profit margin, profit before interest and taxes divided by revenue. So I don't know. I want an interpretation to that place, and we didn't affect that statement in our solution.
But they are hoping to retain a profit before interest and tax of 30% through the net. That's what we did now. Our profit before interest and tax, we just charge 30% of revenue. That's what we get. That's what gave us our profit
So
of it.
this divided by revenue is not relevant.
Profit of interest divided by it's still practically almost the same thing. It's still, but the thing is, okay, do it like this. The way when we have our profit before interest and tax, this figure we had, what was that figure we had? This figure, are you seeing it?
311 and 357.
311. Are you there, sir?
Yes, sir.
Divided by 1035, what would it give you?
Is 3.3.
Eh?
3.3.
Like 311 divided by 1035.
Okay. Okay, that's 30%.
Do you understand? That's still the same grammar they are saying.
Oh, okay.
So what they are saying is it should be 30%. So they are not saying that profit of interest. So if you divide this profit before by your revenue, it should be 30%. That's just the grammar they are playing.
Okay. Thank you very much, sir.
You're welcome. I think I've charged all these questions. Now let me run through the chat box real quick. My screen is being shared. And that overdraft is kind of tricky. Yeah, I get it too. I get it. Honestly, I would have thought like that. That why am I not using? Why are they not passing that? I get it. But like the way I've told you, just do like that, please. This figures I got to maybe like anybody. That's what I said. Now, please put them in those comments. Please do it by yourself. But if I have time, I can help you. If I have time, maybe before I send the working, that means people will have to hold on for the working note till tomorrow. So if I have strength, I can help you put those comments beside it. Is that fine? That means people have to hold on till tomorrow. And when I like, I could send out. Or I should send people go and put the comments by yourself. Anyone that works.
No, sir, please put it yourself, please.
Sure.
Thank you, sir.
We'll wait for you, sir.
Huh? Please, do you have any question? Please, are we fine? Hello, can you guys hear me?
Yes, we can hear you, sir.
Oh yeah. Can you guys hear me, please?
We can hear you, sir.
So are we fine? Please, do you have any question with what I just did?
So what of
Any
the B
question?
aspect
So
of
you're
the
fine?
question?
Excuse me, sir. Good evening, sir.
But this country is not helping us. I have two networks, different networks that I'm switching from, and two of them are doing rubbish. God will help us. So
You only have two. I have three. I have three, and it's like this.
no. So I think there's a B part to the question. I want to just put my attention to it. So what's the B part saying? It can be that the B part was
Recommend and comment on actions the company can take to close the funding gap
good.
identified in AR.
First of all, we need to first even determine if there is a funding gap first, before we know what to tell them. So how do we determine funding gap? If we want to determine the funding gap, what we just do is you compare the requirement. You compare the requirement and what is available. The requirement as in what is, how would I say it? The things you have calculated, like the total for the 2016. You know that we calculated our overdraft. Our overdraft in 2016 is what?
84 million.
84 million plus our bank loan.
160 million.
What's the addition of the two?
244.
So that is the maximum funding requirement. That is what is required. But the one that is available now is our what? Our 160 of what? Our 160 of loan and our overdraft limit, which is 30. Yes, now our overdraft limit, that's the one that is available. You know that I don't think I explain this grammar now. what is required is not what is available. Yes, now that's why it's called forecasting. You are forecasting. So what you forecasted is what is required. So you are forecasting that in 2015, their working capital should be what you said it should be. In 2016, it should be 84. That's what you forecasted, that it should be based on the information. But that is not what is available now. What's available to them is a bank loan of 160 and the Kinecon limit, the overdraft limit of 30. So that's 190. So what is the gap between 190 and that first figure you called for me? Mr. What was that first figure you called for me?
244.
So 244 minus that 190 is what?
54 million.
54 million is the funding gap now. Let me write it. Now don't they look me like so within this man the talk again like this. So what I'm saying, I feel like this one is easier. That question B too is simple. That question two is simple, and I will do it today whether you like it or not. So B, you say funding gap. So come here, say funding gap is equal to let me say funds required minus funds available. So you now say overdraft okay, let me be like this so that people don't get confused. Say funding gap is equals to overdraft. No, this thing will not work like this. So it will not come. I wanted it to contain it once, but let me do it like this then. So come here, say overdraft 160. Let me do it like this. Say funds required. So overdraft 160. No, okay, bank loan, man, 160.
It's bank loan.
So bank loan 160. Overdraft 84.
Yes, sir.
What do I have?
244.
244. That's a funds available. Bank loan, which is what 160. Overdraft
30 million.
Which is 30. So that gives me 190. So what's the funding gap? 54.
54.
I'm never sleep. Oh, this one you're yawning. We have one more question to solve. Oh. 54. So now the question is, now you've noticed that there's a funding gap. Now how can they close this funding gap so that they cannot have this funding gap again? One of the things they can do is they can increase the bank loan. You better write it down one time. I'm not writing that one for you. One of the ways they can do it is they can increase the bank loan. Now they can increase the bank loan. They can increase the bank, so they can reduce capital expenditure. They can reduce capital expenditure. They can also postpone or reduce dividend. They can reduce dividend paid also.
They can increase revenue too.
They can what?
Increase revenue.
Yes, they can increase revenue. They can also increase revenue. They can delay payment to suppliers also. Can delay payment to suppliers. They can speed up cash collection from customers also. All those ones, these ones, they deal with working capital. They can speed up cash collections from customers also. But all these things, just be as you are writing them, don't just write them alone. You know, I've told you. Write the advantages and disadvantages, or disadvantage anyone that works for you. You get the way you said that they should reduce capital expenditure. Now, if they reduce capital expenditure, now it will slow growth, it will slow the growth of company now. Like you're not buying necessary
And it will
machines.
reduce the revenue.
If you don't use the necessary machines now, you can reduce revenue. And it will even affect performance of the business also, which will reduce profit. So those are the reasons. If they reduce dividend, reduction of dividend is even problem. Yes, now because shareholders will not be happy. No, the shareholders will not be happy. That dividend is if dividend is their main income, they will not be happy. It might cause uproar with shareholders. If they delay payment to suppliers, it might cause problem with suppliers also. It might cause suppliers and it might spoil relationship with suppliers. If you want to speed up cash collection from your customer, you sell today, you are already pursuing customer tomorrow. They will not come back again. So you can also chase. So in all these things, the one that is better is to just increase bank loan. JJ. Yes, now if you increase this bank loan, imagine you increase this for these funds available now. Imagine you increase this bank loan by 54. Then you meet your funds required now. But the only problem with increasing bank loan now is your interest. Just make sure that you are making profit or a positive cash flow in the next year, so as to be able to settle that. Stephanie.
Sorry, sir. What about increasing equity? Is it only through bank overdraft? Can they also increase equity? I'm just asking.
Increase what?
Guys, increase capital through equity.
They can, but like it's based on it's based on what we have. That's why we are suggesting bank loan. It's just based on what we have, because I don't think there's any information there that says them doing anything through equity. Although we have shares, we have issue shares, but I don't think there's any information based on the stuff that says anything about equity. That's why we would not want to go through equity. So we are just assuming it's true loan and true debt, because we have no information there. That's why. And if you look at all this, we have overdraft, we have interest paid on loan. So I don't think we want to do anything with equity based on. But you can put it as part of the ways to reduce the to reduce the gap too. Nobody would penalize you for it. So you can say issuing out more shares. But issuing out more shares means you are diluting your shares, and it might reduce the what. So all those things too. Oh yeah. Let me take more questions before I solve the last question. Oh yeah. Mr. Dixon, talk to me real quick, please.
Sorry, sir. There are comments for you in the chat box.
You want to comment for me? Bye. Okay, they said they are not ahead. They were not willing to increase their equity contributions. I don't even see that one. So since that statement is already there, just leave it though. Thank you. Oh yeah. Mr. Dixon, talk to me now. Mr. Jamie, don't talk to me about anything. Okay, I don't open the microphone, sorry. Yeah, Mr. Dixon, I can hear you now. Fast. Mr. Jamie, I can hear you too. So I'll take that
can you
as...
hear me?
Yes, I can hear you now.
Okay, under the funding gap, the overdraft under fund available, is it the one in the question we pick?
Funds available, yes.
Okay, so we pick for the current year, which was 2016 under required, then the initial one in the question, which was 30.
Yes, sir.
All right, thank you very much.
Yeah, Mr. Jamil, please let me solve that down. But I think I will skip a question here. I'm sorry. So this is what I would do. I would want to solve this question 5. But this question 5 is this one is not going to take us anything less than another 2 hours. Low key. Not going to take us anything less than another 2 hours. So I have to leave here by 2. Tomorrow is another working day. So what I would want to do is so I go to question, what's the name now? Question 6. This one would not take us time. This one will not take us nothing less than, I think this is just, it's even mostly theoretical. This Tanko PLC. So I think this would not take us so much time. So next class, I'll just start from question 5. I think that's better. I'll just start from question 5. But if I do that question 5 now, you did it in 1. Oh. So let me just do this one and everybody goes to bed. There's already a lot of information already this night. Is that fine, please? I should go ahead and do question 5. May I did here? I know the one.
No, please.
I'm not even getting it. Everybody was to say yes, yes, please continue. Oh yeah.
Don't continue.
Somebody should read question 6 for us, please. Somebody read question 6 fast.
Okay. Panko Limited TL is currently evaluating 2 different investments, investment 1 and 2, each of which represents strategic investments in different business sectors. At the request of the finance director, the board of directors has convened a special board meeting to consider the appropriate discount rate or rates to use to evaluate the 2 investments. Each of the 2 investments being considered is in a non-listed company and will be financed by 60% equity and 40% debt. In the past, TL has used an estimated post-tax weighted average cost of capital of 12% to calculate the net present value of all investments. The managing director thinks this rate should continue to be used, adjusted if necessary by plus or minus 1% or 2% to reflect greater or lesser risk than the average investment. The finance director disagrees and suggests using the capital asset pricing model to determine a discount rate that reflects the unsystematic risk of each of the proposed investments based on proxy companies that operate in similar businesses. The finance director has obtained the betas and debt ratio of 2 listed companies, Company A and B, that could be used as proxies. These are, we have them, all figures are going to be correct. Other information, the expected annual post-tax return on the market is 8% and the risk-free rate is 3%. Assume the debt that TL raises to finance the investment is risk-free. All 3 companies, TL, Company A and B, pay corporate tax at 25%. TL has one financial objective, which is to increase earnings each year to enable its dividend payments to increase by 4% per annum. The managing director and the other board members are confused about the terminology being used in the CAPM calculation and do not understand why they are being asked to consider a different method of calculating discount rates for use in evaluating the proposed investment required. Discuss the meaning of the term systematic and unsystematic risk and their relationship to a company's equity beta. B. Using CAPM and information given in the scenario about TL and companies A and B, calculate for each of the TL's proposed investments I an asset beta, II, an appropriate discount rate to be used in the evaluation of the investment. C. Discuss briefly how an asset beta differs from an equity beta and why the former is more appropriate to TL's investment decision. Include in your discussion some references on how the use of CAPM can assist TL to achieve its financial objectives. Thank you.
Thank you. You're welcome. Tanko Limited, are we? So this is what I will do. So let me change people's mic so that people will not complain. I'm not saying I like to complain. So I would. So the first question says talk about systematic and non-systematic risk and their relationship to beta. So this is what I would do for the first 30 minutes. That's what I spoke about. So everybody now, if you are listening to me, you are in this class. Based on what I said, go to the comment section and answer that question. Or answer that question in the comment section. I will write it in your working note, but I will off my screen. Yeah, I wicked. So I will off my screen. I go they write my own. You don't yourself they write your own. It's good. It's me that now I was here shouting that time. So you should write in the comment section. Answer it like you're answering it in exam. Systematic risk, unsystematic risk. I think the question also says wait. It says discuss the term here and their relationship to a company's equity better. Is 6 marks. So it's 6 marks. Don't just go and write COVID-19 there and say okay. So if I were you, I would first explain what systematic risk is. Explain what unsystematic risk is. But while explaining systematic risk, I'll talk about what's the name? Talk about the ones that measure what measures systematic risk, what measures unsystematic risk. So once I'm not done, I'm not going to talk about beta in general. I think that is the best way that you can get all your mark. So that's your make I write my own. Make we see the one way go make sense pass. I'm not even everything I want to write for this one. Like, type. Don't wait for my answer. If I vex, I feel delete myself. Because I already explained it before. Write what you want to write to get 6 marks new. Don't write because it's not exam. Write like it's exam. Are you done? Who's up your hand if you're done? I see this. I see this systematic chart. I mean, one guess his marks. Mark listen is systematic. I'm not even joking. I just finished systematic risk. Now make I go do unsystematic. Like I used to tell you people, for people that have never heard me say it before, at least tell people something. If I can give me question that I don't know, lucky for them. But see if they want to make mistake, they should give me the one that I know. And them go on. All the like everything I know about it. If I were you systematic, everything I know, now everything I go write. 6 marks. I thought I'll be targeting 5 out of it. I will be targeting 5. Oh. Let me share my screen. Since most of you are done, let me see it. Let me make I see it when I don't cook. I don't cook with no gel. Even no book small. Represent risk of viability of returns on investment caused by poor management. Leo. Nice one, kind of. I like the grammars. I like the Englishes. The Englishes. No, you can show now everything me the cook. Miss Wumi, I did not see your handwriting here. Oh. Everything here they cook be this. Oh. My own food no sweet. This is my systematic risk and my non-systematic risk. So I copied and pasted this one. I got the editor. I don't get strength to type them again. By alpha. And also called avoidable. Specific. Diversifiable risk. It can be eliminated. It cannot be eliminated, sir, but it can be reduced. Let me say it can be reduced to diversification. Just the event like regulatory change. Another one location. We call it management change. This way I noticed that most of you stopped. Nobody really linked it to better, and that's part of the question. That you should link it to better. So you now come here. You know, say in addition, I've told you people know how to use these words. In addition, come on, can say better is used to measure okay. Is it to measure
the overall return?
Let me call it systematic. Is it to measure systematic risk? by considering considering the uh the Mbudisalo. Okay, let me call it the movement of individual share price against the movement of the market as a whole. I think this is better. This is better small. So please, you can still look for more things and add to it. But with this, I don't think I'm getting anything less than 4 marks. But I know that in the exam I would have added more things relating to this better to it. I would have spoken about the equity better, asset better part. Now I know I would have done that. But I've spoken about what equity beta is, what asset beta is, what they measure. I've told you guys, anything I know, I will write it. I will write it too. So that's all start. So let's go to the B part, please. Time has gone. The B part of the question. This was the B part of the question. Yeah. Yeah. Yeah, well, can be part of the question for me. You should an appropriate discount rate to be used in the evaluation of okay, no. Using CAPM and information company and calculate for proposed investment. Calculate assets better and also so what is saying is we should do asset better and we also calculate the discount rate or discount factor. Are you sleeping? Are you sleeping? Sleeping on the bicycle?
No, sir. No, sir.
When all my co-hosts not even there.
We did, sir.
I hear.
Okay. So yeah, let's calculate say calculation of what did you say calculate itself? Of asset beta. How do we calculate asset beta? At this point, let me unmute the whole class so that it can be far. But please let's comport ourselves. I beg. If you are not giving me answer, keep muted though. How do we calculate asset beta?
We use the proxy complement.
You don't see them. This is one of my problems.
Sorry, can I come in?
Come in where?
He said,
My house.
they said, how do we calculate assets beta? So assets beta is opposed to equity beta times. Don't know if I'm correct. Sometimes I like using abbreviation.
Not the formula. It's not formula I ask. What do I do?
We use the details of the proxy company.
Okay.
To do what?
To calculate the
To on gear.
And see the question to on gear. Identify the proxy company now.
To on gear. Not I know it's proxy company you will use.
On gear the asset beta.
You cannot on gear asset beta, sir. You can only on gear equity
beta. Yes.
To
proxy company.
Okay. You gotta go copy formula.
Step 2 is check if the financing company is geared or ungeared.
Hold on, make I first go dub formula first. Never finish. So writing all those things out. So gloss. Gloss. BD. So real quick, for people for the lucky ones that are in class, because I don't think I will do this again. So let me run you guys through the steps of I know you people know it, but I want you through it again. So what you do is the first what's the name now? For the first step is check for the of mercy. This can we all keep I feel like I prefer that formal method self. So the shouts can we all keep muted. So as I was saying, so I feel like the first step is to check for the what's the name? Check the equity better. Check the equity better of the just check the equity better. Check if
Excuse me,
you are
sir. It's
giving
like
it.
there's mistake here.
Can I continue, please? Can you hold on?
Okay.
If you want to tell me, just raise up your hand. I think that's better, please. So I was saying the first step is to check for what's given to you. Is it equity better that is given to you? Is asset better that is given to you? If it's equity better that is given to you, if it's asset better if it's equity better that is given to you, fine. Then the first step you now do is you ungear the equity better given to you. But you always ungear with proxy companies information. You ungear with proxy companies. What you are trying to do with ungearing is you are getting assets better, which is your BA. But in questions where BA has already been given to you, don't ungear again. I don't know if they are giving you BA, it means they've done the ungearing for you. So don't ungear again. Just go and regear. If you regear now, you are regearing with your own company's information. And you are regearing to remove to account for the financing element. You know, when you do BA is you saying, okay, this company does not have debt. Asset better does not have anything to do with debt. Does not have anything to do with financial risk. It's just business risk. So once you are on gearing, you are just saying, okay, this company does not have anything to do with debt. That's you using the proxy company. But if you are regearing now means you are now taking charge or you are taking account of the financing thing that you removed in the ungearing. So you are now regearing it back. So once you now regear, you now get equity better. So that equity better that you now get back is what you now use in your CAPM. From your CAPM, you get your cost of equity. For your cost of equity, you can whichever method that you want to use, you get your cost of debt, and you get your work. I think that's fine. So, can I continue, please?
Carry on, sir.
Thank you very much. So, so let's start, please. So, but don't forget that we have two proxy companies there, and they said we should calculate for the two of them. So you come here, so you say, let's say company A. So take this here. So what's the equity better of company?
1.3.
1.3.
1 point what?
3.
What's the value of equity?
3.
3.
The value of equity. See it and the ratio of 1 to 3 means their debt is 1 and their equity is 3. So you come here, you say 3. Your value of equity is also 3. Okay. Plus 1. What's your tax rate?
25%.
0.25. I think they have debts better, abi?
0.3.
0.3. What's the value of debt? 1.
1.
0.25. 3. plus 1, 0.25. What do I have?
You answer indeed, sir.
Do you answer? I need to think. I unmuted the whole class to have answers on time.
1.1.
1.1.
1.1.
So you say company B. I don't think this one has depth data now, so I can just copy this part. So what's the asset? What's the equity beta?
0.9.
0.9. What's the value of equity?
6.
Value of debt?
1.
Tax rate?
The same tax rate, 25%, sir.
What's my asset beta?
0.8.
0. Point what?
8.
0.8.
Point 8. So the next step now is to
Vigor.
yeah. So you say B A is equals to B A.
Plus.
So question, please.
Ask me.
What if you average the two of them to get a single unit, sir?
What is written? What
Don't
is
worry,
written?
just go ahead.
You had
It's
it.
for two companies.
Thank you for answering yourself. And usually don't add asset beta and equity beta. Usually, sef, even if it's the same company. I think I solved the question when yesterday I used percentage to add them. Before you see question that you have to add them is rare. I'm giving you a expo. Before you see question that you have to add them basically is rare. Well, what do I have again? VD over VE minus tax. Yeah, company
1.1.
is that my final answer?
Final answer is 1.7.
Yeah, give me one by one.
When did you solve it?
1 minus 0. So what did you use for your value of equity and your value of debt?
Equity is 60, debt is 40. Debt is 40.
That your grammar, I don't understand.
But for company A, beta of debt is not
Equity is
0.
60.
Debt
0.6.
is 1. Debt is 1. No?
Equity is 3.
We're using the values of the company now.
It's when you
Reduce
are
value of
Problem.
company. Which is 60, 40.
It's when you are
60-40.
you will get with your own company's information. Don't go and use proxy company. And this is our own company information 60-40. Debt is 40, equity is 60. Yes, don't make that mistake. Oh. So
60-40, sir.
40, 60. What do I have?
So there's a better depth of 0.3.
That's for proxy company now. Bush no allow us fight too. These are information of proxy company now. Why are you calling it for me? What's my answer?
One point six
1.65.
five.
1.65. What do we have? 0.8. What do I have? This question,
1.2.
this question is just to waste your time. It's simple. Nothing is there. It's just a waste of time question. So nothing is there. Is there these ones you say you don't know?
Sir, I think the company A under that regearing, it has the debt beta. You put zero value there as against 0.3.
You want me to speak it in Chinese? I should speak it in Japanese. That's 0.3 is for proxy company. When you are again, you will get with your own information. This 0.3 debt beta is for proxy company now. So you will not
The
use it
answer
when
is
you
1.
you get
Thank
you
you,
know
sir.
you will not use it when you are again. You only use it when you are on again.
It's 1.2. The answer.
What's my risk for?
3%.
What's my equity beta?
1.65.
RA minus my RF income.
8 minus 3, 5.
8%.
What do I have?
11.25.
Moshe?
What's my risk for?
Listen, 3%.
What do I have?
9.5.
9.5.
9,
Yes.
9.
Next thing. You push our no work formula. When we don't know it. Yeah. What's my cost of equity?
11.25.
What's my value of equity?
60%.
I know this one will confuse some people. Let me do it fully so that people don't make mistake or people don't get confused. Because I know say no problem. But for people that if it was me in exam scenario, in exam situation, I would just come here, easy peasy, and do my 0.6. And now value of equity over value of equity plus value of debt. You are just simply saying 60% divided by 100%. It will still give you 0.6. Let me do it for you people. For you people will say I'm a wicked person. So what I'm saying is, the normal work formula, what would have been S value of equity? That's saying 0.6 over 0.6 plus 0.4. You do this thing like this, it will still give you 0.6. That's the grammar I'm blowing. Yes or yes?
Yes.
Yes. So, okay. So I'll not do it for the second one. No. For this one, I'll just do what's debt. Then what's my cost of debt?
0.03.
Risk free.
Is
Risk
it
free.
is it 3% multiplied by what's the name now? 0.4. So if you do 0.4 divided by 100%, this is what we do. So what's my work?
$7.95.
What do I have?
6.6.
What about Tom? As simple as ABC. It's just a waste of time question, I believe, anyways. Discuss how briefly asset beta differs from an equity beta and why the former is appropriate to assignment.
Sorry, sir.
Hold on 1 minute.
Sorry, sir.
Assignment, do this number C and send to me. Thank you very much. This number C, do it and send. Yeah, I'm listening to your question.
Sorry, my screen full.
I don't hear you.
Let me see if you can hear me, sir.
It's better now.
Can you point me to where we got the cost of debt from?
The risk free, risk free. If you don't see cost of debt in the question, use your risk free.
Okay, sir. Thank you.
There's no cost of debt and there's no information for cost of debt. You can use your risk free. The deep part is the deep part is an assignment. So please do the assignment and submit. Thank you. You ask me.
I noticed we did not do tax on this one, but I went to the question and I see it's post-tax. So that is why I just pressed my case, right? Thank you.
I'm lost. You did not do tax on what?
You know the ones we did previously in previous class when we are working on work, we deduct tax, element of tax in our cost of debt. But I run back to the question I notice is post-tax return. So I think the tax has been taken care of before they give us that receipt.
Most times, okay, let me check the question before I come and answer you. This post-tax return is even on the I'm coming. Hold on, let me check something first. Mm, 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 mm. 1 minute. Which one did you do yesterday or last time? I want to make an assumption, but I want to be so sure before I make that assumption that usually when you use your what's the name now? Whenever you use your risk free, I don't think it's usually post tax. I don't think you charge tax on it. I think it's when you use cost of debt that you charge tax on it. Because this particular one, this post tax is on the what's the name now? Is on the market return. But usually when you use risk free, you don't usually charge tax on it. I'm just saying no. I don't know.
Yes, I think so too. Risk free is exempted from tax, so you will not charge tax.
But I'm not particularly very confident with that. I'm just saying. But this one is so clear that says that it is post tax. This one is so clear that says that it's post tax. But don't worry, sure, I will check out to make sure my assumption is correct. I mean, I don't like to make assumptions that I'm not sure of. But in most questions I've seen, or most whenever you use this free, you don't usually charge it. You don't usually charge tax. Anyways, that's that for that. Any other question, please? When we started this class, we started with 200 and about 220 something. Now we are 107. Out of this 107, about 70 don't sleep first. No, okay, not 70, about 50 or 60 don't sleep. About 10 are already dozing. So the only active people that I have in this class that I'm so sure of, they are no more than 30.
We are awake, sir.
Oh, and so now go they talk.
We are awake. Oh.
We are awake. Oh.
I will stay here with you.
But I don't go sleep for exam all.
So we should solve one more question so that I know that you people are here with me.
No, sir. No, sir. The
All
head is
this
already
work
banging.
there tomorrow.
Let's go there, sir.
Let's go. Fire on.
We are ready.
Information overload.
Very tired now, sir.
Now I like my men. They are the ones shouting fire on. You see, this person don't even say good night. Anything you not like me, I do this night. me, I don't go sleep.
Oh my gosh.
Oh
God.
So let's. I think we have tried. Don't let us do ourselves too much information.
Too much of everything is bad.
It's bad though. It's very bad.
Yes. This one what we don't get now. Maybe we go review them before we come back again.
So I think our next class is on Thursday, Abby. So let's each and every up me your mic. Please let's look at it together.
The recording too.
Yes. So the recorded classes, the recording would be sent, definitely be sent. And the note I would send. People said I should help you to put comment on it. So the
Let
note
it
might
be sent earlier before we go forget them. So that we can work on it again. Thank you.
No problem. People said I should work on the comment, and like this even means if I don't tire, I want to go and sleep. So what I would do is, for goodness and purpose sake, I will send this one first. Let me send it now.
Okay.
Then I will now work on the comment then send that one too. Because if people are waiting on me, I don't want to be receiving you people's call.
Yes, sir.
People's call can frustrate somebody. So I would send this one. Be going on with this one first. So once I'm now done adding some of those things to it, most likely to tomorrow. Anyways, I will now send those ones again, so you can use it to compare whatever you have. I think that works. I think that's fine. So we'll start from question 5 on Thursday. I like the way we are moving. Anyways, we're in question 7-ish. We're going to 15. Is it 15 or 16? So I think we can cover anyways. So on that note, thank you guys very much for listening to me. I would see you guys on Thursday. Have a wonderful night and a wonderful week ahead. Good night.
God bless you, sir. Good night.
God bless.
Good night. Thank you.
Thank you, sir.
Yes, more.
Gracias.
Good night.
Night. Oh.
Get one man ready fine for this class. No one. Vladimir, hold on. I'll answer your question. Don't run away. Stop recording.